Skilled nursing care. Skilled nursing care is a level of medical care that must be provided by trained professionals, such as registered nurses, RNs, licensed practical nurses, LPNs, and certified therapists. This type of care goes beyond basic assistance with daily living and involves specialized medical services that require clinical expertise. For example, someone recovering from a stroke might need physical therapy, wound care, and help managing their medications. If they require daily monitoring by a nurse, along with speech and occupational therapy, they would likely need skilled nursing care. Skilled nursing care can be provided in different settings. Some people receive it in a skilled nursing facility, SNF, which is often part of a rehabilitation center or nursing home. Others may receive home health care, where nurses and therapists visit their homes to provide treatment under a doctor's supervision. Hospitals also provide skilled nursing care for patients recovering from surgery or severe illnesses. Medicare and other insurance plans often cover skilled nursing care, but the level of coverage depends on factors like medical necessity and the length of care needed. For example, Medicare may cover short-term stays in a skilled nursing facility after a hospital admission, but long-term care is generally not covered. Proof of loss. Proof of loss is a formal statement you submit to an insurance company to support a claim for damages, losses, or expenses covered by your policy. It serves as documented evidence of what was lost or damaged and helps the insurer assess your claim. For example, if your home is damaged in a fire, your insurance company will require a proof of loss form detailing the extent of the damage, the estimated cost of repairs, and any supporting documents like receipts, photos, or contractor estimates. Similarly, in health insurance, if you're filing a claim for medical expenses, a proof of loss might include medical bills and records showing the treatment you received. Most insurance policies specify a deadline for submitting proof of loss, often within 30 to 60 days of the incident. If you miss this deadline, your claim could be delayed or denied. Once submitted, the insurer reviews the documentation and determines the payout based on the policy terms. Reinsurance. Reinsurance is insurance for insurance companies. It's a way for insurers to protect themselves from huge financial losses by transferring some of their risk to another insurance company, called a reinsurer. This allows primary insurers to stay financially stable even if they have to pay out large claims. Here's an example. Suppose an insurance company issues homeowners policies in a region prone to hurricanes. If a massive storm causes billions of dollars in damages, the company could struggle to cover all the claims. To prevent financial disaster, the insurer purchases reinsurance, which means the reinsurer will share part of the payout burden. There are two main types of reinsurance. Facultative reinsurance. This is negotiated on a case-by-case basis, where the reinsurer evaluates and decides whether to cover specific policies. Treaty reinsurance. This is a broader agreement where the reinsurer automatically covers a portion of all policies in a certain category. Reinsurance plays a crucial role in keeping the insurance industry stable, allowing companies to take on more policyholders while managing their risk. Representation. Representation refers to statements or declarations made by an applicant when applying for a policy. These statements are considered to be true to the best of the applicant's knowledge and help the insurer assess risk before issuing coverage. However, they are not considered absolute guarantees of truth, unlike warranties, which must be strictly accurate. For example, when applying for life insurance, you might be asked whether you smoke or have any pre-existing medical conditions. If you honestly state that you don't smoke, but later take up the habit, your policy remains valid because your answer was true at the time of application. However, if you intentionally misrepresent information, such as falsely claiming you have no history of heart disease, The insurer may deny a claim or even cancel the policy if they discover the deception. In legal and insurance settings, the accuracy of representations is crucial. If a misrepresentation is deemed material, meaning it significantly impacts the insurer's decision, it could lead to policy denial or voiding of coverage. Underwriting. Underwriting is the process insurance companies use to evaluate risk before issuing a policy. It involves assessing an applicant's information, such as health history, driving record, or property condition, to determine whether they qualify for coverage and how much they should pay in premiums. For example, if you're applying for life insurance, an underwriter will review your medical history, age, lifestyle habits, like smoking or risky hobbies, and possibly even require a medical exam. Based on this assessment, the insurer decides whether to approve your policy and at what cost. Similarly, in auto insurance, an underwriter looks at your driving record, past claims, and the type of car you drive to calculate your risk level. Underwriting helps insurers balance risk so they can remain financially stable while still offering coverage. Some policies, like guaranteed issue life insurance, have no underwriting, meaning anyone can qualify, but they tend to have higher premiums to compensate for the unknown risk. Accidental death and dismemberment. Accidental death and dismemberment, AD&D insurance, is a type of coverage that pays out benefits if the policyholder dies or suffers a serious injury due to an accident. Unlike traditional life insurance, which covers most causes of death, including illness and natural causes, AD&D policies only pay out for accidental events. For example, if someone has an AD&D policy and dies in a car crash, their beneficiaries would receive the full death benefit. However, if they pass away due to a heart attack or cancer, the policy would not pay out. The dismemberment part of the coverage provides a partial payout for serious injuries, such as the loss of a limb, eyesight, or hearing. Typically, the payout amount depends on the severity of the injury. Losing one limb might result in a 50% payout, while losing 2 limbs or eyesight in both eyes could trigger the full benefit. A D&D insurance is often offered as a standalone policy or as a rider on a life or health insurance plan. It can be useful for individuals with high-risk jobs or lifestyles, but it does not replace traditional life insurance due to its limited coverage. Agency. In the context of insurance, agency refers to the relationship between an insurance company and an agent or agency that sells policies on its behalf. The agent acts as an intermediary, helping clients find coverage that suits their needs while representing the insurer. There are 2 main types of insurance agencies. Captive agency works exclusively with one insurance company, selling only that company's policies. For example, a State Farm or Allstate agent can only offer policies from their respective companies. Independent agency works with multiple insurance carriers, allowing them to compare different policies and offer a range of options to clients. An independent agent might sell policies from Progressive, Travelers, and Liberty Mutual, giving customers more choices. Insurance agencies play a key role in guiding policyholders through the insurance process, from selecting coverage to filing claims. They can also help with policy adjustments and renewals. Custodial care. Custodial care refers to non-medical assistance with daily activities such as bathing, dressing, eating, and mobility. It is meant for individuals who need help with basic personal care but do not require skilled medical services. This type of care is commonly provided in nursing homes, assisted living facilities, or at home by caregivers or aides. For example, an elderly individual with dementia who needs help getting dressed and preparing meals would receive custodial care. Similarly, a person recovering from a stroke who cannot bathe or use the bathroom independently might require this type of assistance. Unlike skilled nursing care, which involves medical treatment from licensed professionals, custodial care is typically provided by caregivers who do not need specialized medical training. Because of this distinction, most health insurance plans, including Medicare, do not cover custodial care unless it is part of a short-term recovery plan following a hospital stay. However, long-term care insurance, Medicaid, or private pay can often cover these services. Buyer's Guide. A buyer's guide is a resource that helps consumers make informed decisions when purchasing products or services. It provides detailed information about the features, benefits, and potential drawbacks of different options, as well as tips for selecting the best choice based on individual needs, preferences, and budget. For example, a health insurance buyer's guide might explain the various types of health plans available, like HMO, PPO, and EPO, their costs, the networks of providers, and what benefits are included. It could also cover how to compare premiums, deductibles, copays, and out-of-pocket maximums, helping someone choose the right plan based on their health needs and financial situation. In other cases, a buyer's guide for electronics might break down the different features of laptops, tablets, or smartphones, comparing things like screen size, processing power, battery life, and operating system so you can pick the model that fits your requirements best. A good buyer's guide often includes product or service comparisons to show you the strengths and weaknesses of various options, customer reviews and ratings to offer insights from other consumers, step-by-step recommendations or questions to ask, making the buying process easier. Cobra stands for the Consolidated Omnibus Budget Reconciliation Act, which is a federal law that allows individuals to keep their employer-sponsored health insurance after certain qualifying events, such as losing a job, reducing work hours, or other circumstances that cause someone to lose their health coverage. Under Cobra, if you're covered by a group health insurance plan through your employer and experience a qualifying event, like job loss or a reduction in working hours, you can continue your current health insurance for a limited period, typically 18 to 36 months, depending on the reason for your loss of coverage. You'll have to pay the full premium, including the portion your employer used to pay, plus a small administrative fee, which can make Cobra quite expensive. For example, if you were working full-time and had a health insurance plan provided by your employer, and then you lost your job, Cobra would allow you to continue that same health coverage for a limited time, at your own cost. This can be a helpful option if you need to maintain continuous health insurance while transitioning to a new job or finding alternative coverage. Cobra applies to employers with 20 or more employees and covers not only the employee but also their spouse and dependent children. It's important to note that Cobra doesn't apply to people who were not part of an employer's health insurance plan, nor does it extend coverage indefinitely. It's designed as a temporary bridge. Basic Medical Expense Policy. A basic medical expense policy is a type of health insurance that provides coverage for common, everyday medical expenses like doctor visits, hospital stays, and surgeries. These policies typically cover essential healthcare services, such as inpatient and outpatient care, and are often considered a low-cost option for individuals who don't need extensive coverage. For example, a basic medical expense policy might cover doctor's office visits, usually after you pay a deductible or copayment, hospital stays for surgeries or treatments, emergency room visits for accidents or sudden illnesses, X-rays and lab tests. However, these policies typically have limited benefits and may not cover all types of care. They usually don't provide comprehensive coverage for more specialized treatments or services like maternity care, mental health treatment, or prescription medications. which would need to be added through separate riders or a more comprehensive health plan. A basic medical expense policy is often less expensive than more comprehensive health insurance plans because of its limited coverage. It can be a good option for individuals who need just basic health protection but don't expect to require extensive medical services. Coinsurance. Coinsurance is the percentage of medical costs that you, the policyholder, are responsible for after you've met your deductible. It's a way for health insurance companies to share the cost of your medical care with you. Unlike a co-payment, which is a fixed dollar amount, coinsurance is a percentage of the total medical bill. For example, if you have a 20% coinsurance, it means that after your deductible is met, you'll pay 20% of the cost of any covered medical services, and your insurance will cover the remaining 80%. So, if you go for a procedure that costs $1,000, you would pay $200, 20% of $1,000, and your insurance would pay the other $800. Coinsurance typically applies to services like hospital stays, surgeries, and specialist visits, and the percentage can vary depending on your plan. For example, your coinsurance might be 20% for certain services, but 30% for others, depending on the specifics of your insurance policy. It's important to note that coinsurance, along with co-payments and your deductible, contributes to your out-of-pocket maximum, the maximum amount you'll have to pay for covered services in a year. Once you hit that limit, your insurance will cover 100% of your medical costs for the rest of the year. Competent parties. Competent parties refers to individuals or entities involved in a contract who have the legal capacity to enter into an agreement. In the context of insurance, this means that both the insurer, the company providing the coverage, and the insured, the person or entity purchasing the policy, must be capable of understanding and agreeing to the terms of the insurance contract. For example, an adult of sound mind who can understand the terms and consequences of a health insurance policy is considered a competent party. A minor, someone under the age of 18 in most jurisdictions, is generally not considered competent to enter into contracts unless there are specific circumstances or exceptions, like emancipated minors. Similarly, if someone is mentally incapacitated or under the influence of drugs or alcohol, they may not be considered competent to agree to a contract. In an insurance contract, the insurer is typically considered competent if it is a legally recognized company, and the insured must be competent to make decisions regarding their coverage. If one of the parties is not competent, the contract may not be valid or enforceable. So, for a life insurance policy, if a person who is not mentally competent, say, due to a medical condition, tries to sign the policy, the contract could be challenged later. Similarly, if a minor tries to enter into a car insurance policy, the insurer may refuse coverage based on the lack of legal capacity to contract. Concealment. Concealment in insurance refers to the act of intentionally withholding or hiding important information that is relevant to the insurance policy or claim. This is a form of misrepresentation and can have serious consequences, as insurers rely on full and honest disclosure from policyholders to assess risk and determine appropriate coverage. For example, if you're applying for life insurance and fail to disclose a pre-existing medical condition, such as heart disease, that is material to the insurer's decision, this would be considered concealment. If the insurer later discovers this information during the claims process, such as after your death, they may deny the claim or cancel the policy for non-disclosure. Concealment can apply not only to application information but also to the claims process. For instance, if you file a claim for a car accident but fail to disclose that the vehicle had a history of prior damage that might affect the repair cost, this could also be seen as concealment. In insurance contracts, there is typically a duty of utmost good faith, known as uberrimae fidei, which means both parties, the insurer and the insured, are expected to act transparently. If concealment is proven, it can lead to policy cancellations, claim denials, or even legal action. Dental insurance. Dental insurance is a type of health insurance specifically designed to cover the costs associated with dental care. It helps policyholders manage the expense of routine dental procedures like cleanings, fillings, and exams, as well as more complex treatments like root canals, crowns, and orthodontics. Dental insurance can be purchased as a standalone policy or as part of a larger health insurance plan. Most dental insurance plans fall into three categories: preventive care. This includes basic services like routine checkups, cleanings, and x-rays, and is usually covered at 100% by most dental plans. The goal here is to catch problems early and prevent more serious dental issues down the road. Basic services. These can include fillings, extractions, and simple dental work. Coverage for these services typically ranges from 70% to 80%, meaning the patient would pay the remaining percentage. Major services. This includes more complex procedures like crowns, bridges, dentures, and sometimes root canals. These procedures are often covered at a lower rate, such as 50%, leaving the patient responsible for the rest. Many dental insurance plans also have an annual maximum, a cap on the total amount the plan will pay for dental services in a year. If you reach that limit, you would need to pay any additional costs out of pocket. Additionally, dental insurance often comes with a waiting period before certain treatments are covered, especially for more expensive procedures. When considering dental insurance, it's important to check whether your preferred dentist is within the plan's network. If it's a PPO or HMO, the premium costs, and any out-of-pocket responsibilities like co-payments and deductibles. Exclusion rider. An exclusion rider is a provision added to an insurance policy that excludes coverage for specific conditions, situations, or types of losses. It essentially outlines the circumstances under which the insurer will not provide benefits or coverage. This rider is added to a policy either at the time the policy is issued or later, if there are particular risks or concerns that the insurer doesn't want to cover. For example, in life insurance, an exclusion rider might be added to exclude coverage for death resulting from certain activities, like skydiving or participation in high-risk sports. This means if the policyholder dies while participating in one of these activities, the insurer would not pay out the death benefit. Similarly, in health insurance, a rider might exclude coverage for certain pre-existing conditions, such as a chronic illness, or treatments like cosmetic surgery. Exclusion riders are typically used to limit the insurer's risk while still offering coverage for other, more standard risks. They are important to carefully review before agreeing to a policy because they can significantly impact the scope of coverage you'll receive. For example, if you're getting disability insurance and you have a pre-existing back condition, the insurer might offer an exclusion rider to exclude claims related to that specific condition, meaning you won't receive benefits for any disability claims caused by your back. Deductible. A deductible is the amount of money you must pay out of pocket for covered services before your insurance starts paying. In simpler terms, it's the portion of the cost of your medical bills or any other type of insurance claim that you're responsible for before your insurance kicks in to help cover the rest. For example, if you have a $1,000 deductible on your health insurance plan, you would need to pay the first $1,000 of your medical expenses each year. After that, your insurance would cover a larger portion of your medical costs, depending on your plan's details, like coinsurance or co-payments. Here's how it works in practice. If you go to the doctor for a visit that costs $200, you'll pay the full $200 out of pocket because you haven't yet reached your deductible. If you later have a medical procedure that costs $2,500, you'll pay $800 more to meet your deductible, since you've already paid $200 of the total. After meeting the deductible, your insurer will typically cover a significant portion of the remaining costs. Some plans have separate deductibles for specific services, like prescription drugs or hospitalization. There are also family deductibles for plans that cover multiple people, meaning the family as a whole needs to meet the deductible before the insurance covers further costs. In general, higher deductibles tend to come with lower premiums, meaning you'll pay less each month for coverage, but take on more financial responsibility when it comes time to use the insurance. Conversely, lower deductibles often mean higher premiums, with the insurance company covering more of your expenses up front. Express authority. Express authority refers to the specific powers granted to an insurance agent by the insurer, which are clearly outlined in a contract or agreement. This authority is given directly and explicitly, meaning the agent can perform certain actions, like selling policies, binding coverage, or handling claims, as specifically stated by the insurance company. For example, if an insurance agent is hired by an insurer to sell auto insurance, the insurance company will grant the agent express authority to sell policies, provide quotes, and perhaps even make minor adjustments to existing policies. However, this authority doesn't extend beyond the terms of the agreement. If the agent tries to make decisions outside their express authority, such as binding the company to coverage for a type of insurance the company doesn't cover, they are not legally allowed to do so. Express authority contrasts with implied authority, which is the ability to perform tasks that are necessary to fulfill the agent's role, even if they're not explicitly written out in the contract. For instance, while an agent may not have express authority to bind coverage for a specialized policy, they may have implied authority to answer general questions or give advice within their scope of knowledge. In short, express authority is about what the agent is specifically authorized to do according to the terms of their contract with the insurer. And it's crucial that both parties, agent and insurer, understand the limits of this authority to avoid legal complications. Disability. Disability in an insurance context refers to a condition that prevents an individual from performing their regular work or daily activities due to illness or injury. It is also the basis for disability insurance, a type of coverage designed to replace lost income when someone is unable to work due to a disability. There are two main types of disability insurance. Short-term disability, STD. This provides coverage for a limited period, often 3 to 6 months, after a person is unable to work due to a disability. Short-term disability insurance typically covers a percentage of the individual's income, often 60 to 80%. It kicks in after a brief waiting period, like a few days to a week, following the onset of the disability. Long-term disability, LTD. This type of insurance provides benefits for an extended period, potentially lasting years or until retirement age, depending on the policy. It covers a percentage of income, often 50 to 70%, after a longer waiting period, which could range from several months to a year. Long-term disability benefits continue until the individual is able to return to work or reaches the policy's expiration, such as age 65. Disability insurance can be purchased privately or may be provided through an employer. Employer-provided disability coverage often covers a percentage of the employee's salary, but many individuals purchase additional private policies to fill in the gaps or extend the duration of their benefits. Disability insurance typically has a waiting period, often referred to as an elimination period, which is the amount of time a person must be disabled before they start receiving benefits. During this period, the person would not receive payments. This period can range from a few days for short-term policies to several months for long-term policies. If you become disabled, you would typically need to provide medical evidence or documentation to show that you're unable to perform your job duties, and benefits would be paid accordingly. Guaranteed renewable. Guaranteed renewable is a term used in insurance to describe a policy that, as long as the premium is paid, cannot be cancelled by the insurer, except for reasons such as non-payment. Additionally, the insurer is required to renew the policy at the end of each term, typically annually, without changing the terms, except for adjustments in the premium. For example, in the context of health insurance, if you have a guaranteed renewable policy, the insurance company cannot cancel your policy just because you develop a health condition. As long as you continue paying your premiums, the insurer must renew your coverage when it's time to renew the policy, even if your health status has changed. However, they may increase the premium for everyone in the same group or demographic, but they cannot single you out for a premium hike due to your health. The key feature of guaranteed renewable policies is that they provide security to the policyholder because they don't risk losing coverage simply because they get sick, face financial difficulty, or reach an older age. However, premiums may still increase, particularly as the policyholder gets older, though this increase must be applied across all policyholders in that class or group. For example, if you purchase a life insurance policy with a guaranteed renewable rider, the insurer is obliged to renew the policy each year, regardless of any changes in your health, as long as the premiums are paid on time. The company can't cancel it due to a condition that develops during the policy period. Enrollment period. An enrollment period refers to a specific time frame during which individuals can apply for or make changes to their insurance coverage, such as health, dental, or life insurance. During this period, eligible people can enroll in a new plan, make adjustments to their existing coverage, or switch plans without needing a special reason. If someone misses the enrollment period, they may have to wait until the next one or meet specific requirements to qualify for coverage outside the usual window. For example, in the context of health insurance, there are generally two major enrollment periods. Open enrollment. This is the primary period each year when you can enroll in, switch, or make changes to your health insurance plan. For most people in the U.S., this occurs in the fall, typically between November and December. During open enrollment, anyone can apply for or adjust their coverage regardless of health status, and they may qualify for subsidies or other benefits if eligible. Special Enrollment Period, SEP. If you experience a qualifying life event, such as losing your job, getting married, having a baby, or moving to a new area, you might qualify for a special enrollment period. This allows you to enroll in or change your plan outside of the regular open enrollment window. For Medicare, there's also an enrollment period that typically starts 3 months before your 65th birthday and lasts for 7 months. After this period, you may face penalties or delays in enrolling if you don't sign up when you're first eligible. Life insurance often has annual enrollment periods if it's provided by an employer, while some plans have continuous or rolling enrollment opportunities, allowing you to sign up or make changes at various points in the year. Missing an enrollment period can limit your ability to get coverage or make changes to your existing plan. In some cases, waiting for the next enrollment period can leave you without necessary coverage. Hazard. In the context of insurance, a hazard refers to any condition, event, or situation that increases the likelihood of a loss or makes a loss more severe. Essentially, a hazard is something that heightens the risk of a claim being made under an insurance policy. There are several types of hazards in insurance, which can be categorized into 3 main types: physical hazards, moral hazards, and morale hazards. Physical hazard. This involves tangible physical conditions that increase the risk of a loss. For example, a slippery floor in a business could be considered a physical hazard because it increases the risk of an employee slipping and getting injured. Similarly, having a fire hazard due to old wiring in a building would be a physical hazard that could increase the risk of fire damage. Moral hazard. This refers to the risk that a person may behave recklessly or irresponsibly because they have insurance coverage. For example, someone with car insurance might drive more carelessly because they know their insurance will cover the costs of any accident. Moral hazard involves a change in behavior as a result of knowing you are financially protected. Moral hazard. This is similar to moral hazard, but involves an attitude of carelessness or indifference that comes from the feeling of being insured. For instance, if someone doesn't maintain their property because they know they have homeowners insurance, they might inadvertently increase the risk of damage or loss. It's less about intentionally causing harm, as in moral hazard, and more about neglecting precautions or safety measures. Insurance companies assess hazards when determining the level of coverage, premiums, and terms of a policy. If hazards are deemed high, they may raise premiums or refuse coverage altogether to mitigate their potential risk. Fraud. Fraud in the context of insurance refers to any dishonest or deceptive act done by an individual, whether it's a policyholder or an insurance company, with the goal of gaining an unfair advantage or benefit. This could involve providing false information, exaggerating or making up claims, or hiding important details to get a payout, lower premiums, or avoid following the insurance rules. When it comes to policyholder fraud, this happens when the person with the insurance intentionally gives false or misleading information, either to get coverage at a cheaper rate or to make fraudulent claims. For example, someone might exaggerate an injury to collect disability benefits or workers' compensation. Another example could be staging a car accident or intentionally damaging their property just to file a claim and receive insurance money. Sometimes people even misrepresent the value of their property to lower their premiums or hide its true condition to make it look like less of a risk. On the other side, insurer fraud happens when the insurance company itself engages in deceptive practices. They might deny a legitimate claim to avoid paying out what's owed or fail to disclose crucial information about coverage, exclusions, or policy details that would affect the customer's decision-making. Insurance fraud is illegal and can lead to serious consequences for anyone caught in the act. Penalties can include fines, criminal charges, and even imprisonment. Plus, fraudulent claims end up driving up the cost of insurance for everyone, since the financial burden gets passed on to honest policyholders. Insurance companies have teams that are dedicated to detecting and investigating fraud. They use a mix of audits, investigations, and even data analysis to identify suspicious activity and ensure that claims are legitimate. Disability income insurance. Disability income insurance is a type of insurance that provides financial support if you are unable to work due to illness, injury, or disability. Its main purpose is to replace a portion of your lost income when you're temporarily or permanently unable to perform your job duties. This kind of insurance helps ensure that you can still meet your financial obligations, like paying bills, while you're recovering or adjusting to life with a disability. Disability income insurance typically offers two types of coverage: short-term disability and long-term disability. Short-term disability usually covers a period ranging from a few weeks to several months, depending on the policy, and it kicks in after a brief waiting period, often a few days to a week. Long-term disability insurance covers you for a more extended period, sometimes until you reach retirement age, and usually takes effect after you've exhausted short-term coverage. The amount of income replacement provided by disability insurance can vary. Most policies replace around 50 to 70% of your pre-disability income, though this amount can depend on your specific policy, your job, and any other forms of income you may have. Some policies may also include additional features like rehabilitation benefits, cost of living adjustments, or the ability to add extra coverage through riders. A key aspect of disability income insurance is the elimination period, which is the amount of time you must be disabled before you start receiving benefits. The longer the elimination period, the lower your premium will typically be, but it means you'll need to wait longer before the insurance coverage kicks in. Having disability income insurance is especially important if you rely on your ability to work to support yourself or your family. It provides a safety net if something unexpected happens and helps reduce financial stress during a challenging time. Domestic insurer. A domestic insurer is an insurance company that is incorporated and operates in the same country where it sells its insurance policies. Essentially, it's an insurer that is based in and regulated by the government of the country in which it was formed. For example, if an insurance company is based in the United States and sells policies to U.S. residents, it would be considered a domestic insurer in the U.S. This is in contrast to foreign insurers, which are incorporated in one country but operate in other countries. For instance, a Canadian insurance company that sells policies in the U.S. would be considered a foreign insurer in the U.S. The key difference for a domestic insurer is that it is subject to the laws and regulations of the country in which it was created. In the U.S., domestic insurers are regulated by state insurance departments, which ensure they comply with the state's insurance laws, including requirements for financial stability, policyholder protection, and consumer rights. For policyholders, buying insurance from a domestic insurer can sometimes offer more direct oversight and easier access to claims resolution, as the insurer is subject to local laws and regulatory bodies. Additionally, domestic insurers might be more familiar with the specific risks and needs of residents in that country, which can result in policies that are better tailored to the local market. Health Maintenance Organization. A health maintenance organization, HMO, is a type of health insurance plan that provides comprehensive coverage through a network of doctors, hospitals, and other healthcare providers. The primary feature of an HMO is that it requires members to choose a primary care physician, PCP, who serves as their main point of contact for most healthcare needs. The PCP is responsible for managing the patient's overall care and referrals to specialists within the HMO network. One of the key benefits of an HMO is that it typically offers lower premiums and out-of-pocket costs compared to other types of health insurance plans, like preferred provider organizations, PPOs. However, HMOs come with stricter rules about how and where you receive care. For example, if you want to see a specialist, you generally need a referral from your PCP, and the insurance will only cover care received within the HMO network, except in emergency situations. If you seek care outside the network without proper referral or authorization, you might be responsible for the full cost. HMOs are known for focusing on preventative care. They aim to keep costs down by encouraging regular checkups, screenings, and other measures to prevent more serious health issues down the line. The idea is that by managing care through a network of providers and focusing on prevention, the overall healthcare costs can be controlled. While HMO plans are generally more affordable, they offer less flexibility in terms of choosing providers. If you're someone who prefers to have a wider range of doctors and specialists to choose from, or if you need more flexibility in how you seek care, an HMO might not be the best option. But for individuals who value lower costs and are comfortable with the structured network of providers, an HMO can be a good choice. Health insurance. Health insurance is a type of insurance that helps cover the cost of medical expenses. It provides financial protection against the high costs of healthcare by covering part of the expenses associated with doctor's visits, hospital stays, surgeries, medications, preventive care, and other healthcare services. Instead of paying the full price for medical treatments out of pocket, a person with health insurance typically pays a premium, a regular payment, often monthly, and, in some cases, a deductible, an amount they must pay before the insurance starts covering costs. Health insurance plans vary widely depending on the type of coverage they offer, the network of healthcare providers, and how much they cost. Health insurance is essential because medical expenses can be incredibly high, and having insurance can protect you from the financial burden of serious illness or injury. Whether you get health insurance through an employer, purchase it individually, or receive it through a government program like Medicare or Medicaid, having coverage gives you access to necessary medical services while helping to manage costs. Hospital expense insurance. Hospital expense insurance is a type of health insurance that specifically covers the costs associated with staying in a hospital. This coverage typically includes a range of expenses related to inpatient care, such as room and board, surgical procedures, laboratory tests, medications administered during a hospital stay, and other essential services provided while you're hospitalized. Hospital expense insurance usually covers expenses for things like room and board. This includes the cost of the hospital room and meals during your stay. Surgical costs. It helps cover the cost of surgeries, including the surgeon's fees and any anesthesia needed. Medications and treatments. Hospital treatments, including any medications administered while you're hospitalized, are often included in the coverage. Diagnostic tests. Tests such as blood work, X-rays, or MRIs performed during the hospital stay may also be covered. Nursing services. Fees for hospital nursing staff and other support services while you're under care. This type of insurance generally does not cover outpatient care, routine doctor's visits, or ongoing medical treatments that don't require a hospital stay. Hospital expense insurance is often offered as a supplemental policy, either as part of a broader health plan or as a standalone policy to provide additional protection if you're hospitalized. While some comprehensive health insurance plans include hospital expenses, hospital expense insurance is designed to help fill in gaps for those who want more protection or have specific concerns about hospital-related costs. It can be especially helpful for those with high deductibles, co-pays, or co-insurance in their primary health insurance. In some cases, hospital expense insurance is a good option for people who have existing health insurance, but want additional coverage for things like long hospital stays or specialized treatment that may lead to significant out-of-pocket costs. Insuring clause. The insuring clause is a fundamental part of an insurance policy that outlines the insurer's basic promise to provide coverage. It's where the insurer agrees to cover specific types of losses or risks, as long as the policyholder continues to pay their premiums. Essentially, it's the part of the policy that makes the insurer legally obligated to provide compensation for covered events. The insuring clause usually spells out exactly what is covered by the policy. For instance, in a health insurance policy, it might state that the insurer will cover medical expenses related to illness, injury, or emergency care. It also clarifies any conditions under which the coverage applies, such as requiring the policyholder to notify the insurer within a certain period of a claim or meet specific criteria for treatment or care. It's the section of the contract where the insurer promises to provide financial protection according to the terms of the policy. This includes specifying how claims will be handled and what the insurer will pay for in exchange for the premiums you pay. Essentially, it's the insurance company's guarantee that, in the event of a covered loss, they will step in and help with the costs. In a life insurance policy, for example, the insuring clause would state that the insurer will pay a specified benefit if the policyholder passes away, assuming all terms and conditions are met. This clause is crucial because it sets the tone for the rest of the policy. While other sections go into details about exclusions, limitations, and conditions, the insuring clause is where the core coverage is promised. Insurance. Insurance is a financial arrangement where an individual or entity receives financial protection or reimbursement from an insurance company in case of specific types of loss, damage, or injury. In exchange for this coverage, the policyholder pays a regular fee, called a premium, to the insurance company. Essentially, insurance helps to manage financial risk by providing a safety net when unexpected events occur. There are many types of insurance, each designed to cover specific risks. For example, health insurance helps cover medical expenses. Auto insurance covers vehicle-related damages, and life insurance provides financial support to loved ones after a policyholder's death. When you buy insurance, you're essentially transferring the financial risk of an event happening, like getting sick, being in an accident, or losing property, to the insurer. The idea is that the insurer pools money from many people, and in return, policyholders are protected from large, potentially devastating financial losses. If you experience a covered event, the insurer will pay for part or all of the costs depending on the terms of the policy. The amount of coverage, the specific risks covered, and the premiums can vary widely depending on the type of insurance and the details of the policy. Some insurance plans require deductibles, the amount you pay before the insurance covers the rest, co-pays, fixed amounts you pay for services, and co-insurance, a percentage of the costs you're responsible for. Insurance is important because it provides peace of mind, knowing that if something goes wrong, whether it's health issues, property damage, or an accident, you won't have to bear the entire financial burden alone. Home health care. Home health care refers to a range of medical and non-medical services provided in a patient's home to help with recovery, manage chronic conditions, or assist with daily living activities. This type of care allows individuals to receive necessary medical attention or assistance in the comfort and familiarity of their own home, rather than in a hospital or nursing facility. There are two main types of home health care: skilled and non-skilled care. Skilled home health care involves medical services provided by licensed professionals, such as nurses, physical therapists, or occupational therapists. This can include services like administering medications, wound care, monitoring vital signs, and helping patients with rehabilitation after surgery or injury. It's typically prescribed by a doctor and may be covered by health insurance or Medicare, depending on the situation. Non-skilled home health care focuses on daily living assistance and personal care, like help with bathing, dressing, meal preparation, light housekeeping, and companionship. This type of care is often provided by home health aides or caregivers, and it's particularly helpful for individuals who need assistance due to aging, illness, or disability, but do not require medical treatment. Home health care can be a critical service for people recovering from surgery, managing long-term health conditions, or dealing with physical limitations that make daily tasks difficult. It offers the benefit of more personalized care, often at a lower cost than staying in a hospital or nursing facility, and it allows individuals to maintain a sense of independence and dignity in their own environment. Would you like to learn more about how home health care works, its costs, or insurance coverage for these services? Lapse. A lapse in insurance refers to the termination or cancellation of an insurance policy due to non-payment of premiums or failure to meet other requirements outlined in the policy. When a policy lapses, the coverage is no longer active, and the insured person is no longer protected against the risks the policy was meant to cover. The most common cause of a lapse is non-payment of the premium. If you fail to pay your premium by the due date, and there is no grace period to cover that, the insurer may consider the policy lapsed. However, many insurance companies offer a grace period, typically 30 or 60 days, during which you can still pay your premium and keep the policy active. If payment isn't received by the end of the grace period, the policy will lapse. Once a policy lapses, it can be difficult to reinstate without going through certain procedures, which may involve paying back premiums or providing evidence of insurability. especially for life and health insurance policies. In some cases, a lapse could lead to the loss of coverage for pre-existing conditions or certain benefits. It's important to keep track of your premium payments and any other requirements in your policy to avoid a lapse in coverage. If you're worried about missing a payment, many insurance companies allow you to set up automatic payments or reminders. Implied authority. Implied authority refers to the powers and actions that an insurance agent or representative can take on behalf of the insurer, even though these actions are not explicitly stated in the contract. It's authority that is assumed based on the nature of the agent's role and the tasks they are expected to perform in order to carry out their duties effectively. For example, if an agent is authorized to sell insurance policies, their implied authority would include activities necessary to complete that task, such as answering questions from potential clients, explaining the terms of policies, or collecting premiums. Even though these actions may not be explicitly stated in the agent's contract, they are understood as part of the role in facilitating the sale and management of insurance policies. Implied authority is different from express authority, which is clearly defined in the contract between the insurer and the agent. While express authority specifies exactly what the agent is allowed to do, implied authority covers the day-to-day functions that the agent needs to perform their job, even if not written out specifically. For instance, if a customer calls an insurance agent to inquire about coverage, the agent has implied authority to provide general information or even offer quotes, even though these actions may not have been explicitly mentioned in the contract. Implied authority helps ensure that agents can effectively manage their responsibilities, but it also means that they must act within the bounds of what's considered reasonable and expected in their position. If an agent steps outside of these implied duties, the insurer may not be held accountable for their actions. Law of large numbers. The law of large numbers is a fundamental principle in insurance and statistics that helps insurers predict future events more accurately. The law states that as the number of similar risks or exposures increases, the actual results, like the number of claims or losses, will more closely approximate the expected results. In simpler terms, the more data or participants an insurer has, the more predictable the outcomes become. In the context of insurance, this principle works by spreading risk across a large group of policyholders. Insurers use the law of large numbers to estimate the likelihood of specific events, like car accidents, illnesses, or natural disasters, and set appropriate premiums. By pooling the risks of many individuals, the insurer can predict, with greater accuracy, how much it will need to pay out in claims, and how much it needs to charge in premiums to cover those claims and remain profitable. For example, an insurer might not know exactly when or how much a specific policyholder will claim, but with thousands or millions of policyholders, they can rely on the law of large numbers to predict the overall claims experience. This helps the insurer to set premiums that are fair and sufficient to cover claims without charging too much or too little. The law also helps in creating more stable pricing. Because the insurer is working with a large pool of policyholders, the effect of any one large claim is reduced, and the overall cost of claims becomes more predictable over time. This allows insurers to avoid sudden spikes in premiums and helps keep coverage more affordable for policyholders. Overall, the law of large numbers is essential in helping insurance companies stay financially stable and provide accurate coverage to their customers. Intermediate nursing care. Intermediate nursing care is a level of health care that offers more support than basic custodial care, but doesn't require the intense medical attention of skilled nursing care. It's for individuals who need some medical supervision or assistance with their health, but not the full range of services that you'd get in a hospital setting. People who need intermediate nursing care may still need regular monitoring of their health, like checking vital signs or watching over their condition, but they don't need 24-hour intensive medical care. While they might need help with daily activities like bathing, dressing, or eating, the medical oversight is higher than what you'd get with custodial care. It might also include some rehabilitation or therapy services, like physical therapy or occupational therapy, to help them regain function or maintain their independence, but it's not as intensive as what you'd receive in a hospital or a skilled nursing facility. This type of care is usually found in places like nursing homes, assisted living facilities, or specialized care units. It's ideal for people who are recovering from surgery, managing chronic illnesses, or transitioning from a hospital stay back to their home environment. While skilled nursing care requires services from registered nurses, intermediate nursing care typically involves nurse aides and licensed practical nurses, LPNs, providing a more basic level of care. Overall, intermediate nursing care provides an effective and cost-efficient option for individuals who need more care than basic custodial services, but don't require the intense medical interventions of skilled nursing care. It helps fill that middle ground where people can recover, stay stable, and still maintain a good quality of life. Legal purpose. Legal purpose is a requirement in insurance contracts that ensures the subject matter of the policy and the actions involved are lawful. In other words, for an insurance policy to be valid and enforceable, it must have a legal purpose. If the purpose of the contract involves something illegal, such as insuring an illicit activity or a criminal act, the contract would be void. For example, you can't take out an insurance policy to cover a business that's involved in illegal activities, like selling banned substances. Similarly, if someone tries to insure a life policy for a person who is about to commit a crime, the policy wouldn't be considered valid because it's based on an unlawful situation. In general, the legal purpose requirement is there to make sure that insurance policies are being used for legitimate, lawful purposes, aligning with public policy. This protects both the insurer and the insured, ensuring that they aren't involved in agreements that could lead to criminal or unethical situations. Medicare Part A. Medicare Part A is a key part of the U.S. federal health insurance program that primarily focuses on covering inpatient care in hospitals, skilled nursing facilities, hospice care, and some home health services. It's often referred to as hospital insurance because it mainly helps cover the costs associated with hospital stays and related services. When you're admitted to a hospital, Part A helps cover things like room and board, nursing services, and other hospital care costs. If you need skilled nursing care after being in the hospital, Part A can also help cover some of the costs for stays in skilled nursing facilities. But there are specific requirements, like needing to be in the hospital for a certain amount of time before you qualify. Another key area that Part A covers is hospice care, which provides pain relief, counseling, and support to patients facing terminal illness, typically in a home setting or in a hospice facility. It also covers certain home health care services if they're related to your recovery after a hospital stay, like physical therapy or post-surgery care. Most people don't have to pay a premium for Part A if they or their spouse have worked and paid Medicare taxes for at least 10 years. However, there are still costs to be aware of, like deductibles and coinsurance, depending on the type of care you receive. It's worth noting that while Part A covers inpatient care, it doesn't cover outpatient services, doctor visits, or prescription drugs. Those are covered under Medicare Part B and Part D, respectively. Long-term care. Long-term care refers to a variety of services that help individuals with chronic illnesses, disabilities, or other conditions that limit their ability to perform everyday activities. Unlike traditional medical care, which focuses on treating specific health conditions, long-term care is more about providing assistance with daily living tasks over an extended period. People often need long-term care when they can't perform basic activities like bathing, dressing, eating, or moving around on their own. It's not just for the elderly, though. It can also be necessary for people of any age who have serious health conditions or injuries, such as a stroke or spinal cord injury. Long-term care can take many forms, depending on the level of care needed and where the person lives. For some, this might mean receiving help at home from caregivers, such as assistance with personal care or housekeeping. For others, it could mean staying in a nursing home or an assisted living facility, where they can receive 24/7 care from professionals. There are also options like adult day care centers, which provide care during the day for those who live with family members but need help while their family members are at work. It's important to note that long-term care isn't typically covered by standard health insurance or Medicare. Medicare does cover short-term care, like a few weeks of nursing home care after a hospital stay, but long-term care generally requires a separate policy, such as long-term care insurance. This type of insurance helps cover the costs of extended care, which can be quite expensive. Medicare Part D. Medicare Part D is the part of the Medicare program that helps cover the cost of prescription drugs. If you have Medicare, Part D can help with the cost of medications that are prescribed by your doctor, whether you take them on a short-term or long-term basis. This coverage is available through private insurance companies that are approved by Medicare, and you can get it as a standalone prescription drug plan or as part of a Medicare Advantage plan, which is Part C. Medicare. Part D helps reduce the amount you have to pay out of pocket for prescriptions, but it's important to know that there are some costs involved. This typically includes a monthly premium, which can vary depending on the plan you choose, an annual deductible, if applicable, and copayments or coinsurance for each medication. The amount you pay can vary based on the specific drug, the plan, and whether the drug is covered under your plan's formulary, the list of medications covered by the plan. Medicare Part D also helps protect you from high prescription drug costs through something called the donut hole. This is a coverage gap that happens after you and your plan have spent a certain amount on covered drugs. In the past, this gap meant you had to pay a larger portion of your drug costs, but the Affordable Care Act has been working to reduce the amount you pay during this period. You can sign up for Part D when you first become eligible for Medicare, and it's important to enroll when you're first eligible, because waiting could mean higher costs or penalties later on if you decide to enroll after your initial eligibility period. Part D is a great option for people who need help managing the cost of prescription medications, especially if they have ongoing health conditions that require regular prescriptions. National Association of Insurance Commissioners. The National Association of Insurance Commissioners, NAIC, is a U.S. organization made up of state insurance regulators. Its primary goal is to coordinate the regulation of the insurance industry across all states, ensuring that the industry operates in a way that protects consumers, maintains fair competition, and promotes financial stability. The E&D on C doesn't directly regulate insurance companies, but it works closely with state insurance departments to develop model laws, regulations, and standards that states can adopt to ensure consistency and fairness in insurance practices. This helps make sure that insurance policies are written and administered properly, and that insurance companies are financially sound and able to meet their obligations to policyholders. In addition to setting regulatory standards, the NAIC also provides a variety of resources for consumers, such as educational materials about insurance policies, consumer protections, and how to file complaints or resolve disputes with insurers. They also monitor and report on industry trends and statistics, which helps regulators and consumers better understand the state of the insurance market. One of the key roles of the NAIC is the development of the model laws and regulations, which states can use to create their own insurance laws. This helps to ensure that, even though insurance is regulated at the state level, there is a certain level of consistency in how insurance laws are applied across the country. Overall, the NAIC plays an important role in maintaining a fair, transparent, and financially stable insurance industry that works in the best interests of consumers. Medicare. Medicare is a U.S. federal health insurance program primarily designed for people aged 65 and older, but it also covers certain younger individuals with disabilities or specific medical conditions, such as end-stage renal disease, ESRD, or amyotrophic lateral sclerosis, ALS. The program helps cover the cost of healthcare services, making it more affordable for those who are eligible. Medicare is divided into different parts, each covering specific types of care. Medicare Part A is often referred to as hospital insurance. It covers inpatient hospital stays, skilled nursing facility care, hospice care, and some home health care services. Most people don't have to pay a premium for Part A if they or their spouse have paid Medicare taxes for at least 10 years. Medicare Part B is known as medical insurance. It covers outpatient care, doctor visits, preventive services, and some home health services that aren't covered by Part A. Part B requires a monthly premium, and the costs vary depending on income. It also has an annual deductible, and you'll usually have to pay a portion of the costs, such as co-insurance or co-payments, for services covered under Part B. Medicare Part C is also called Medicare Advantage. It's an alternative to original Medicare, Parts A and B, and is offered by private insurance companies approved by Medicare. Medicare Advantage plans cover all the services provided by Parts A and B, and many of them also include additional benefits, such as prescription drug coverage, Part D, vision, dental, and hearing services. Medicare Part D helps with the cost of prescription drugs. It is provided through private insurance companies that are approved by Medicare. You can get Part D coverage as a standalone plan or as part of a Medicare Advantage plan. Medicare is an essential program for millions of Americans, providing access to necessary medical care and helping reduce the financial burden of healthcare costs, especially for older adults or those with chronic conditions. However, while Medicare covers a lot, it doesn't cover everything. For example, long-term care, most dental care, and vision care typically aren't covered, so many people have additional private insurance or other coverage to fill in the gaps. Non-disabling injury. A non-disabling injury refers to an injury that doesn't result in long-term or permanent impairment, disability, or loss of function. Essentially, it's an injury where the person is able to recover quickly and return to their normal activities without lasting consequences. These types of injuries might cause temporary pain, discomfort, or inconvenience, but they don't typically require ongoing medical treatment or lead to permanent disability. For example, a person might sprain an ankle or suffer a mild concussion from a fall. While the injury may cause some pain or require short-term rest, it doesn't permanently affect the person's ability to walk, work, or engage in daily life activities after a relatively short recovery period. In the context of insurance, non-disabling injuries might not qualify for long-term disability claims or permanent injury compensation. However, they may still be covered under certain policies, such as health or accident insurance, which may help with the cost of medical treatment, temporary loss of income, or rehabilitation if needed. Non-disabling injuries are common in both work-related and personal injury scenarios, and while they're generally less serious than disabling injuries, they still require attention to ensure proper healing. Pre-existing condition. A pre-existing condition is a health condition or illness that a person has before applying for or enrolling in a new health insurance plan. This could include chronic conditions such as diabetes, asthma, heart disease, or even conditions like cancer or mental health disorders. Essentially, It's any medical condition that existed prior to the start of your insurance coverage. In the past, many health insurance companies would deny coverage or charge higher premiums for people with pre-existing conditions. However, the Affordable Care Act, ACA, passed in 2010, made it illegal for insurance companies to refuse coverage or charge higher rates based on pre-existing conditions. This means that, under ACA-compliant plans, individuals with pre-existing conditions cannot be discriminated against when applying for health insurance. However, it's important to note that pre-existing conditions can still have an impact on certain types of insurance. For example, in life insurance or disability insurance, a pre-existing condition might be considered during the underwriting process and could influence the premiums or terms of the policy. Insurers might require additional documentation or impose waiting periods for coverage related to the pre-existing condition. For health insurance, many people are now covered regardless of pre-existing conditions, but for other types of insurance, it's worth checking with the insurer to understand how they handle pre-existing conditions. Peril. A peril in insurance refers to a specific event or cause of loss that can lead to damage or injury. It's the event that the insurance policy is designed to protect against. For example, common perils in homeowners insurance might include fire, theft, vandalism, or natural disasters like earthquakes or floods. In health insurance, perils might involve accidents, illnesses, or specific medical conditions. When you purchase an insurance policy, you're essentially buying protection against these potential risks or perils. For example, if your home is damaged in a fire, which is a peril, your homeowner's insurance may cover the cost of repairs or replacement. Similarly, if you're injured in an accident, another peril, your health or auto insurance might help cover medical costs. Different types of insurance policies cover different perils, and understanding the specific perils covered is important when choosing a policy. Some policies, like comprehensive car insurance, offer broader coverage for a wide range of perils, while others may focus on specific risks. For example, a flood insurance policy specifically covers the peril of flooding, which is typically not included in standard homeowners insurance. Notice of Claims Provision. The Notice of Claims provision in an insurance policy outlines the process and timeline for informing the insurance company about a claim after an event covered by the policy has occurred. Essentially, this provision specifies how soon after an accident, loss, or other insured event the policyholder needs to notify the insurer, and what information must be provided. Typically, the notice of claim should be made promptly, often within a set period, such as 30 days or 60 days, depending on the terms of the policy. If the policyholder fails to provide notice within the required time frame, the insurance company may deny the claim, or, at the very least, reduce the amount of coverage provided. The Notice of Claims provision also outlines the type of details that need to be included when reporting the claim, such as the date and nature of the incident, the parties involved, and any initial documentation of damage or loss. The more thorough and timely the notice, the smoother the claims process is likely to be. For example, if someone files a claim after a car accident, the insurance company typically wants to be notified within a few days of the event. If a policyholder waits too long to report the claim, the insurer could argue that the delay prevented them from properly investigating the situation, potentially leading to a denial of coverage. Having a clear understanding of the Notice of Claims provision is crucial for ensuring that claims are processed efficiently and that policyholders don't inadvertently lose out on coverage due to delays or lack of communication. Preferred, standard, substandard, or decline. In the context of insurance, preferred, standard, substandard, and decline are terms used to describe the different classifications of risk or the underwriting categories that determine an individual's eligibility for coverage and the pricing of their premiums. These categories are primarily used in life insurance, but can also apply to other types of insurance, like health or auto, to some extent. Preferred refers to individuals who are considered to be low risk to the insurer. These people typically have excellent health, good lifestyles, and no significant medical conditions. As a result, they are eligible for the best rates available in terms of premiums. For example, someone with no history of smoking, a healthy weight, and no chronic diseases might be classified as preferred. Standard is the classification for people who are average risks. They may have some minor health issues or lifestyle factors, like being overweight or having a family history of certain conditions, but they're still considered insurable at standard premium rates. Most people fall into this category and can expect to pay the usual rates for their insurance coverage. Substandard refers to individuals who are considered to be higher risk due to health conditions, a history of smoking, dangerous activities, or other factors that make them more likely to file a claim. These individuals may still be eligible for coverage, but they will generally face higher premiums to offset the higher risk they present to the insurer. For example, someone with a history of heart disease or a chronic illness might fall into the substandard category. Decline means that the insurer has decided not to offer coverage at all. This can happen if the person's health, lifestyle, or other factors are considered too risky for the insurer to provide coverage, or if the individual is ineligible due to certain conditions, such as terminal illness or a high-risk profession. People who are declined typically cannot obtain insurance through that company, though they may be able to seek coverage from other insurers or through specialized policies. Understanding these categories is important because they affect both your eligibility for insurance and how much you'll pay for it. Insurers use underwriting criteria to assess which classification fits your profile based on your health, lifestyle, occupation, and other factors. Preferred Provider Organization. A preferred provider organization, PPO, is a type of health insurance plan that offers flexibility in choosing healthcare providers. PPOs are popular because they allow you to see any doctor or specialist without needing a referral, which gives you more freedom in managing your health care. However, to get the most out of a PPO plan, it's best to use a network of healthcare providers that the plan has agreements with. In a PPO, healthcare providers are divided into two categories: in-network and out-of-network. In-network providers are those that have contracted with the PPO to offer services at discounted rates. If you choose to see an in-network provider, you'll generally pay less for medical services, as these providers have agreed to the PPO's negotiated prices. However, unlike some other types of insurance plans, like health maintenance organizations or HMOs, PPOs allow you to see out-of-network providers as well, though at a higher cost. The PPO will still cover part of the bill, but you'll likely pay higher deductibles, co-pays, and coinsurance for these services. The flexibility to see any provider you want, whether they're in the network or not, makes PPOs a popular choice for those who prefer more control over their healthcare decisions. PPOs also tend to offer a wider range of services and specialists. Since you don't need a referral to see a specialist, you can schedule appointments directly with specialists as needed, which adds to the convenience of the plan. One of the trade-offs with PPOs is that they typically have higher premiums and out-of-pocket costs compared to other plans like HMOs, which limit your choices and require you to get referrals for specialist care. However, many people are willing to pay the higher costs for the increased flexibility that a PPO offers. Probationary period. A probationary period in insurance refers to the initial period of time after a policy is issued during which certain benefits may not be available or claims might not be fully covered. This is a waiting period that policyholders must go through before their full coverage kicks in. The length of a probationary period can vary depending on the type of insurance policy, such as health, life, or disability insurance. For example, In health insurance, a probationary period might mean that if you get sick or injured within the first few months of your policy, your insurer may not cover those specific conditions until the probationary period ends. The purpose of the probationary period is to reduce the risk for the insurance company, ensuring that they don't have to cover costs for conditions that the policyholder might have had before purchasing the insurance. In disability insurance, the probationary period may be used to exclude coverage for certain pre-existing conditions or to set a waiting time before full benefits are available. This period can range from a few weeks to several months, depending on the policy and insurer. For life insurance, the probationary period is often referred to as the contestability period, which is typically 2 years. During this time, if the policyholder dies, the insurer may investigate the claim more closely to ensure there was no misrepresentation of health or lifestyle on the application. It's important for policyholders to understand the terms of their insurance policy, including any probationary period, so they can avoid any surprises or gaps in coverage. Partial disability. Partial disability refers to a condition in which a person is unable to perform all of their normal job duties or daily activities due to an injury or illness, but is still able to work in some capacity or perform some tasks. Essentially, the individual is not fully disabled, but is experiencing a reduced level of functionality. In the context of disability insurance, partial disability often means that the person can continue working, but not at full capacity. For example, if someone has a back injury and cannot perform heavy lifting or long hours, but they are still able to do desk work or other light duties, they may be considered partially disabled. In these cases, disability insurance may provide benefits that are a percentage of the full disability benefits, depending on the extent to which the person's ability to work is impaired. Partial disability can apply to both short-term and long-term disability insurance policies. In some policies, there may be a specific benefit period for partial disability, during which the individual can receive partial income replacement. For instance, if someone is partially disabled and can work only half-time, the insurance may cover part of their lost income during that period. The exact terms of what qualifies as partial disability can vary by insurer and policy, so it's important to review the details of your disability insurance plan to understand the coverage. Some policies may have different definitions or conditions for partial disability, and there may be requirements for documentation or assessments to confirm the extent of the disability. Substandard risk. A substandard risk refers to a person whose health, lifestyle, occupation, or other factors make them a higher risk to insure than the average person. In insurance terms, this means that the individual is more likely to make a claim, either due to a medical condition, risky behavior, or certain life circumstances. As a result, those classified as substandard risk typically face higher premiums or more limited coverage compared to someone considered a standard risk. For example, someone who has a history of heart disease or diabetes may be considered a substandard risk in life or health insurance. People who smoke, engage in dangerous sports, or work in high-risk professions like construction or logging may also be classified as substandard risks because their activities make them more prone to accidents or health issues. Insurance companies assess risk when underwriting a policy and determine whether a person falls into the standard, substandard, or preferred risk category. If someone is deemed substandard, the insurer might offer coverage, but at a higher premium to offset the additional risk they pose. In some cases, coverage could come with exclusions or limitations on certain types of claims, depending on the nature of the risk. The idea is to balance the insurer's need to cover potential losses with the individual's need for affordable coverage. Substandard risks are still insurable, but the higher premiums or additional restrictions help ensure that the insurer can manage the potential increased claims. Stop-loss provision. A stop-loss provision is a feature in health insurance or group health plans that limits the amount of money a policyholder or employer has to pay out of pocket for healthcare expenses in a given year. Essentially, it serves as a safeguard to prevent excessive medical costs by setting a maximum limit on the amount of money an individual or employer will need to pay for covered healthcare services during a policy period, typically 1 year. For example, in a health insurance plan, if your out-of-pocket expenses, such as deductibles, co-payments, and coinsurance, reach a certain threshold set by the stop-loss provision, the insurer will cover 100% of the additional medical costs for the remainder of the year. This means once you hit the stop-loss limit, you won't need to pay further costs for covered services, giving you financial protection against catastrophic health expenses. In the context of employer-sponsored health plans, a stop-loss insurance policy is often purchased by the employer to protect against very high claims. This is particularly relevant in self-insured plans, where the employer directly pays for workers' medical claims rather than through an insurance company. Stop-loss insurance kicks in when claims exceed a certain amount, protecting the employer from financial loss due to unexpectedly high medical expenses. The stop-loss provision can be a critical feature, particularly for individuals or employers who might face unpredictable or large healthcare costs. It helps provide peace of mind by ensuring that once a certain financial threshold is crossed, the risk of further expenses is minimized. Total disability. Total disability refers to a condition where an individual is completely unable to perform the duties of their occupation or any other work they are qualified for due to an illness or injury. In the context of disability insurance, total disability typically means that the person cannot do any job or engage in any substantial gainful activity because of their medical condition. For example, if someone suffers from a severe injury, such as a spinal cord injury that leaves them unable to walk or use their hands, they may be considered totally disabled. Similarly, someone with a debilitating illness, such as advanced cancer, may also qualify as totally disabled if they are unable to continue working in their field. In most disability insurance policies, total disability is the condition that qualifies the individual for the highest level of benefits, often providing a significant portion of the individual's income while they are unable to work. The specific definition of total disability can vary between policies. Some policies might only cover total disability that prevents the person from performing the duties of their specific occupation, often referred to as own occupation disability, while others may define it more broadly as being unable to perform any occupation for which the person is reasonably suited by experience or education, any occupation disability. It's important to review the terms of a disability policy to understand how total disability is defined, as policies may have different criteria or waiting periods before benefits begin. Residual disability benefit. A residual disability benefit is a feature in some disability insurance policies that provides partial income replacement to individuals who are still able to work but are unable to perform all of their usual duties due to an injury or illness. This benefit is designed to help people who are partially disabled, meaning they can work but not at full capacity, by covering the difference in their income before and after the disability occurred. For example, imagine a person who has a back injury that prevents them from performing physically demanding tasks at their job. While they can still do office work or lighter tasks, they may not be able to earn as much as they did before the injury. In this case, a residual disability benefit would help compensate for the lost income. The benefit typically pays a portion of the difference between the person's pre-disability earnings and their current income, up to a certain limit. This benefit is especially valuable because it supports those who are not completely disabled, but still face significant challenges that reduce their ability to earn a full income. The criteria for residual disability benefits can vary depending on the insurer and policy, but they usually require that the individual meet certain conditions, such as being unable to perform a specific percentage of their job duties or experiencing a significant decrease in income. In many cases, the residual disability benefit is offered in conjunction with a total disability benefit. So if the person's condition worsens and they are unable to work at all, they could transition from receiving partial benefits to receiving full disability benefits. Respite care. Respite care refers to temporary relief or short-term care services provided to family caregivers who are responsible for taking care of a loved one, typically someone who is elderly, ill, or has a disability. The primary purpose of respite care is to give caregivers a break, allowing them time to rest, attend to personal matters, or take care of their own health without worrying about the day-to-day needs of the person they are caring for. Respite care can be provided in various settings, such as the home, a daycare facility, or a nursing home, depending on the needs of the person receiving care. The duration of respite care can range from a few hours to several days, allowing the caregiver flexibility in how long they need a break. It can also be planned in advance or used in an emergency situation if the caregiver is unable to provide care temporarily. For example, a family member who is taking care of an elderly parent with Alzheimer's might use respite care services to take a weekend trip or attend to other personal responsibilities, knowing that their parent is in good hands for a short time. In some cases, respite care is covered by long-term care insurance, Medicaid, or other health care plans, but the details can vary depending on the policy. The idea behind respite care is not only to support the physical needs of the person being cared for, but also to ensure that caregivers can maintain their own well-being, which is crucial to preventing caregiver burnout. Utilization review. Utilization review is a process used by health insurance companies and healthcare providers to assess the necessity, quality, and efficiency of healthcare services being provided to patients. The goal of utilization review is to ensure that treatments, procedures, and hospital stays are medically necessary, cost-effective, and appropriate for the patient's condition. Utilization review typically occurs at different stages of care, including pre-authorization, concurrent review, and retrospective review. Pre-authorization, or prior authorization, happens before a patient receives a specific treatment, procedure, or service. The healthcare provider submits a request to the insurer to ensure the proposed care is covered and deemed necessary. For example, if a patient needs an MRI, the insurer may need to approve it beforehand, confirming that the procedure is medically justified. Concurrent review takes place during a patient's treatment or hospital stay. This ongoing evaluation ensures that the care continues to be appropriate and necessary as the patient's condition evolves. For instance, if a person is admitted to the hospital for surgery, the insurer might review the stay to confirm that it is still required and that the patient is receiving the right level of care. Retrospective review happens after treatment has been provided. The insurer or healthcare organization reviews the care given to determine if it met the criteria for being medically necessary and if it was appropriately billed. If any discrepancies or unnecessary services are found, the insurer may deny payment for those services. Utilization review helps control healthcare costs by preventing unnecessary or excessive treatments, while ensuring patients receive the right care at the right time. However, it can also be a point of frustration for patients and providers if treatments or services are delayed or denied during the review process. Unilateral. Unilateral refers to something that is done or decided by only one party or side, without the involvement or agreement of others. In a general sense, it means one-sided or independent action. In the context of insurance or healthcare, unilateral often comes into play when referring to actions or decisions made by a single party. For example, A unilateral contract in insurance is a contract where only one party, typically the insurer, makes a promise or commitment, while the other party, the insured, doesn't have to provide a reciprocal promise. An example is a life insurance policy, where the insurer agrees to pay a benefit if the insured person passes away, but the insured doesn't have to do anything beyond paying the premium. In a medical or healthcare context, unilateral can also describe conditions or treatments that affect only one side of the body. For example, unilateral pain refers to pain that occurs on only one side of the body, like a one-sided headache or joint pain. Recurrent disability provision. A recurrent disability provision is a feature in disability insurance policies that addresses situations where a disability that had previously been covered by the policy reoccurs after the individual has returned to work. Essentially, this provision ensures that if a person returns to work after recovering from a disability and then experiences a relapse or re-injury related to the original condition, the insurance company will treat it as part of the same disability rather than a new claim. For example, if someone was out of work due to a back injury and then returned to their job after several months of recovery, but later experienced the same back issues that prevent them from working again, the recurrent disability provision would ensure that they are not required to go through the entire waiting period or new claim process. Instead, the insurer would resume paying benefits under the original disability claim, often without requiring a new elimination period or having to prove the disability is completely new. This provision is particularly useful for individuals with conditions that are prone to flare-ups or recurrences, such as chronic back problems, mental health conditions, or other long-term health issues that may not be fully resolved even after treatment. It's important to note that recurrent disabilities are typically only covered under the provision if the new disability occurs within a certain time frame after the initial disability ended, which can vary depending on the insurer and policy. Once the specified period has passed, a recurrence may be treated as a new disability. Scheduled benefit. A scheduled benefit is a type of benefit provided by an insurance policy that pays a predetermined fixed amount for specific conditions, procedures, or types of care. These benefits are scheduled in advance and are not based on the actual costs incurred, but rather a set amount specified in the policy. For example, in health insurance or disability insurance, a scheduled benefit might cover certain medical treatments or surgeries, with a fixed amount paid for each service. If you undergo a procedure like a surgery, the insurance policy might specify that it will pay a set benefit amount for that surgery, regardless of the actual cost of the procedure. In disability insurance, a scheduled benefit might apply to specific injuries or conditions. For instance, if someone suffers a loss of limb or eyesight, the policy might list a specific benefit amount for each of those types of disabilities, which is predetermined by the insurance company. These benefits are typically seen in policies where the insurance company wants to limit its liability for certain expenses, or where the cost of care can vary widely. For example, in accidental death and dismemberment, AD&D insurance, the policy might provide a scheduled benefit for the loss of a limb or eye, specifying the amount the insurer will pay for each of these conditions. Scheduled benefits offer predictability in terms of how much an individual can expect to receive, but they also limit the payout to the amounts listed in the schedule, regardless of the actual expenses or loss. Reasonable and customary charge. Reasonable and customary charge refers to the typical cost for a specific medical service or procedure within a particular geographic area. Insurance companies often use this term when determining how much they will pay for a covered healthcare service. The idea is that the insurer will pay for the cost of a service up to the point where it falls within the range of what is considered reasonable and customary in that area. If the charge exceeds this range, the insured person may have to pay the difference. For example, if you go for a routine medical test, the insurance company may have a cap on how much they consider a reasonable and customary charge for that test based on what most healthcare providers in your region charge. If your doctor charges more than the usual cost for that service, you might be required to pay the extra amount out of pocket. The reasonable and customary charge is determined based on a few factors. Geographic area. Different areas may have different standard pricing due to local market conditions, provider competition, or cost of living. Provider. Fees may vary depending on whether the provider is a specialist or generalist. Type of care. Some services, especially elective or specialized care, may have different pricing standards compared to routine or emergency care. This concept is more commonly used in health insurance plans, particularly in traditional or indemnity plans, where the insurance may reimburse a percentage of the reasonable and customary charges, with the insured being responsible for the rest. It helps insurers manage their costs while ensuring that policyholders aren't paying excessively for routine or common procedures. Prospective review. Prospective review is a process used by healthcare insurers and providers to evaluate and approve medical treatments, procedures, or services before they are actually provided to the patient. This review happens prior to the delivery of care and aims to determine whether the planned treatment or service is medically necessary, appropriate, and cost-effective. For example, if a doctor recommends a specific surgery for a patient, a prospective review would involve the insurance company reviewing the details of the procedure, the patient's medical history, and other relevant information to decide if the surgery is justified and will be covered under the insurance policy. If approved, the insurer will typically guarantee that the treatment will be covered up to the policy's limits. Prospective review is often used for elective surgeries, diagnostic tests, or treatments that may involve significant costs. It helps prevent overutilization of healthcare services and ensures that both patients and providers follow a treatment plan that aligns with medical guidelines and standards. One common form of prospective review is pre-authorization or prior authorization, where the insurer must approve certain treatments before they are carried out. This helps to prevent unnecessary treatments and ensures that the patient receives care that is medically necessary. This type of review benefits insurers by controlling costs and ensuring appropriate care, while also helping patients avoid unexpected out-of-pocket expenses for services that might not be deemed necessary or covered under their plan. Open Panel HMO. An open panel HMO, Health Maintenance Organization, is a type of managed care health insurance plan that offers a bit more flexibility than a traditional HMO, while still maintaining some of the core features of a managed care plan. In a traditional HMO, members are required to get care from a specific network of healthcare providers. These providers typically must be part of the HMO's exclusive network, and members often need referrals from their primary care physician, PCP, to see a specialist. An open panel HMO, however, allows members to see providers outside the HMO network, although the out-of-pocket costs for services received from non-network providers are usually higher. While network care is typically covered at a higher rate, the open panel HMO gives members the option to go outside the network if needed, without completely excluding those outside services from coverage. For example, if you're enrolled in an open panel HMO and need a specialist, you can first try to see someone within the network, where your costs are lower. But if you prefer or need to see a specialist outside the network, you can still get coverage, though you may face higher deductibles, co-pays, or co-insurance. This flexibility makes open panel HMOs attractive to individuals who want the affordability of an HMO, but also the freedom to choose care providers outside the plan's network when necessary. However, the trade-off is usually higher costs when you go outside the network, so it's important to weigh your options and understand the costs before seeking out-of-network care. Primary insurance amount. The primary insurance amount, PIA, is a term used in the context of Social Security benefits, specifically referring to the amount of money an individual is eligible to receive in Social Security disability or retirement benefits. The PIA is the calculated base amount that an individual will receive each month once they begin drawing their benefits, before any additional adjustments, like cost of living increases, are applied. To determine the PIA, the Social Security Administration, SSA, uses a formula based on a person's average indexed monthly earnings, AIME, over their working lifetime. The AIME takes into account the individual's highest earning 35 years of work, adjusted for inflation. The formula uses different bend points to determine how much of the earnings will be replaced by Social Security benefits. For example, someone who has a higher AIME will receive a higher primary insurance amount. However, the PIA is also adjusted for factors such as the age at which you begin claiming Social Security benefits, e.g., at full retirement age versus earlier or later. Once the PIA is determined, it is used as the starting point for calculating the amount of disability or retirement benefits the person will receive. If someone applies for benefits early, before their full retirement age, their benefits may be reduced from the PIA amount. Conversely, if they delay claiming until after full retirement age, they may receive a higher monthly benefit. The PIA essentially serves as the foundation for how much a person will receive from Social Security based on their work history and earnings. Offer. An offer in the context of contracts and insurance refers to a proposal made by one party to enter into an agreement with another party. It outlines the terms and conditions under which the offering party is willing to engage in a contract. In the case of insurance, an offer is typically made by the insurance company to provide coverage to a potential policyholder based on the details of the policy they are requesting. For example, when you apply for an insurance policy, the insurer might review your application, assess the risks, and then make an offer in the form of a policy quote. This offer would include the terms of the coverage, premium amounts, and any exclusions or conditions. If the policyholder agrees to these terms and accepts the offer, a contract is formed. An offer is considered to be legally binding once it is accepted by the other party. If the terms of the offer are not accepted as is, but instead countered with changes or modifications, this would be considered a counteroffer, which could start a new round of negotiations. In insurance, the offer could also refer to the initial proposal made by a policyholder, such as an application for coverage, which the insurer may accept, reject, or modify. Presumptive disability benefit. A presumptive disability benefit is a feature in some disability insurance policies that provides benefits to an insured individual if they suffer from certain severe disabilities that are automatically considered disabling without the need for further medical proof. These disabilities are often outlined in the policy and are considered presumed disabilities, meaning they are so serious that the insurer does not require additional documentation to prove the extent of the disability. For example, common conditions covered under a presumptive disability benefit might include the total and permanent loss of sight in both eyes, the loss of both hands or both feet, or the loss of speech. If an insured individual experiences one of these conditions, they would typically qualify for the full disability benefits immediately, regardless of whether they meet the usual criteria for disability under the policy. The key advantage of this provision is that it simplifies and accelerates the claims process for individuals suffering from these severe and life-altering conditions. Rather than having to go through the usual disability claims process, which may involve proving the severity of the condition and its impact on the ability to work, the person automatically qualifies for benefits. For example, if a person loses their sight in both eyes due to an accident or illness, the insurer would pay out the agreed-upon disability benefits under the Presumptive Disability Benefit Clause, even without requiring the person to demonstrate how the condition affects their ability to perform everyday activities or work. Presumptive disability benefits can vary by insurance company and policy, so it's important to review the terms of a policy to understand which conditions are included under this provision. Own occupation. Own occupation is a term commonly used in disability insurance policies to define the type of work an individual is considered disabled from, and it plays a crucial role in determining whether benefits will be paid. Specifically, if a policy is based on own occupation coverage, it means that the insured person is eligible to receive benefits if they are unable to perform the specific duties of their own job, even if they could work in another occupation. For example, let's say someone works as a surgeon, and they suffer an injury that prevents them from performing surgery but doesn't stop them from working in another capacity, like in an administrative or teaching role. Under an own occupation policy, they would still be eligible for disability benefits because they can no longer perform the tasks of their specific occupation, surgeon, even if they could do other types of work. This type of coverage is generally more favorable to the insured because it offers a broader safety net, ensuring that people receive benefits if they are unable to do the job they were trained and employed to do, even if they could technically perform other work. However, there are some limitations with own occupation coverage. Many policies with own occupation definitions are limited in duration. Typically, this type of coverage might only last for a few years. After that period, the definition of disability may shift to any occupation coverage, which is more restrictive and states that the insured is only considered disabled if they cannot perform any job for which they are reasonably suited by education, training, or experience. Proof of loss provision time frame. The proof of loss provision time frame in an insurance policy specifies the period within which a policyholder must submit proof to the insurer after a loss or claim event occurs. This provision is important because it sets a deadline for the policyholder to provide all necessary documentation to support their claim, allowing the insurer to process and assess the validity of the claim. Typically, the proof of loss needs to be submitted within a specific number of days, often ranging from 30 to 90 days after the loss. However, the exact time frame can vary depending on the type of insurance policy and the insurer's requirements. If the policyholder fails to submit the proof of loss within the specified period, it may result in a delay or even a denial of the claim, unless the policyholder can show that it was not feasible to submit the proof within the time frame due to exceptional circumstances. The proof of loss generally includes providing the insurer with the details of the loss, such as the nature of the incident, the extent of the damage or injury, medical records, in health or disability claims, police reports, in theft or accident claims, and any other relevant documentation that can substantiate the claim. For example, if a homeowner's property is damaged by a storm, the proof of loss provision would require the homeowner to submit a claim, along with the necessary documentation, photos of the damage, repair estimates, etc., within the specified time limit to receive compensation for the loss. In some cases, insurers may grant extensions to the time frame if the policyholder has a valid reason for not being able to submit proof on time, but this is typically at the insurer's discretion. Accidental means provision. The accidental means provision is a term often found in life, disability, or accident insurance policies. It specifies that for a claim to be paid, the injury or death must result from an accident that occurred due to an unexpected or unintentional event. This provision is used to distinguish between injuries or deaths that occur as a result of an accident and those that occur because of intentional actions, pre-existing conditions, or other causes that aren't deemed accidental. Under an accidental means provision, the key factor is that the cause of the injury or death must be both unforeseen and unintentional. For example, If someone is injured in a car accident, the insurer would look at whether the event was accidental in nature and whether the injuries were directly caused by the accident itself. However, the provision could be stricter than it sounds. It doesn't just require an accident to occur, but that the injury must happen due to an accidental means. This is in contrast to an accidental death and dismemberment, AD&D policy, which typically uses a broader interpretation of accident, but can still have restrictions. Let's say someone is walking and trips, injuring themselves. If the injury was the direct result of an accident and not due to a prior medical condition like fainting, it would likely fall under the accidental means provision, meaning they could potentially receive benefits. It's important to note that some insurance policies may have a more inclusive definition of accident or injury, while others may be more restrictive, requiring clear proof that the injury or death occurred as a result of a specific, unintentional event. Adverse selection. Adverse selection refers to a situation where individuals who are more likely to need insurance are also more likely to purchase it, while those less likely to need it may avoid it. This can create an imbalance in an insurance pool, where the insurer ends up covering a higher number of high-risk individuals than anticipated. For example, imagine a health insurance plan where only people with chronic health conditions sign up because they know they'll need medical care. On the other hand, healthier people might avoid signing up because they don't expect to use the services much. As a result, the insurer ends up paying out more in claims than they collect in premiums, which can lead to higher costs for everyone or potentially unsustainable pricing for the insurer. Adverse selection is a key concern in insurance markets, and one way to prevent it is through mechanisms like mandatory coverage or penalties for not having insurance, as seen in some health systems or through government mandates. Any occupation. Any occupation is a term often used in disability insurance policies to define the criteria for when an individual is considered disabled and eligible for benefits. Under this definition, an insured person must be unable to perform any occupation that they are reasonably suited for based on their education, training, or experience. For example, if a person has a specialized job as a surgeon but becomes unable to perform surgery due to an injury, the any occupation definition would consider whether they could work in a different role, perhaps as a medical consultant or in administration, to determine if they qualify for disability benefits. If they could still work in another capacity, even though they can't perform their original job, the insurer may not consider them fully disabled under this policy. This standard is stricter than own occupation coverage, where someone might still receive benefits if they can't perform their specific job, even if they can work in other roles. Any occupation can make it harder to qualify for benefits because it considers a broader range of possible employment. Aleatory. Aleatory is a term used in insurance to describe a type of contract where the outcome depends on chance, or where one party might receive a significantly greater benefit than the other, depending on circumstances. Essentially, it's a situation where the value of the contract isn't equal for both parties at the outset, and it's determined by an uncertain event. In the context of insurance, this means that the insurer and the insured enter into a contract where the insurer may collect premiums for years without having to pay out a large claim. Or, conversely, the insurer may have to pay out a large amount if the insured suffers a loss. For example, if you pay a small annual premium for health insurance, but then need a very expensive surgery, the insurer would pay much more than what you've contributed. This is the aleatory nature of insurance. The risk is uncertain, and the payoff isn't guaranteed to be equal for both sides. It's a fundamental characteristic of most insurance contracts, and it reflects the idea that the amount paid by each party varies based on future, unpredictable events like accidents, illness, or property damage. Change of occupation provision. A change of occupation provision is a clause in some disability insurance policies that allows the policyholder to adjust their coverage if they change jobs or occupations. Essentially, if someone with disability insurance switches to a new job or occupation that has a different level of risk or pay, the insurer may modify their benefits, premiums, or terms of coverage to reflect this new situation. For example, let's say you have a disability policy that covers you based on your job as a high-risk construction worker. If you later switch to a less risky office job, the insurance company might lower your premiums or adjust your benefits, since the new job poses less risk of injury. On the flip side, if you take a job with higher risk, the insurer might increase your premiums or reduce the benefits you receive if you can't work due to a disability. This provision helps insurers balance the risk they're taking on by tailoring the policy based on the policyholder's occupation. It ensures that the coverage is aligned with the new risks the insured might face in their updated role. Credit accident and health insurance. Credit accident and health insurance is a type of policy that is often tied to a specific loan or credit agreement. It's designed to protect the borrower in the event that they suffer an injury, illness, or other health issues that prevent them from being able to repay the loan. Essentially, the insurance helps cover the loan payments if the borrower becomes disabled or unable to work due to an accident or health problem. For example, if someone takes out a car loan and opts for credit accident and health insurance and later becomes seriously ill or injured and cannot work, the insurance would step in to help cover the car loan payments. The goal is to prevent the borrower from defaulting on the loan due to unforeseen health issues. This type of insurance is often offered by lenders when a loan is being taken out. And while it can provide peace of mind, it's important to note that it usually only covers the loan balance and often comes with limited benefits. It's distinct from traditional health insurance in that it's specifically linked to a loan or credit arrangement, and typically the benefit is paid directly to the lender rather than the insured person. Capital sum. Capital sum is a term used in insurance, particularly in accident or life insurance policies, to refer to the lump sum amount that will be paid out in the event of a claim. It's typically a fixed amount stated in the policy that is payable to the policyholder or their beneficiaries in the event of death, serious injury, or another specified event. For example, in an accidental death and dismemberment (AD&D) policy, the capital sum might be the amount the insurer agrees to pay if the policyholder dies in an accident. If the policy specifies a capital sum of $100,000, that would be the payout to the beneficiaries after the insured's death in an accident. In some policies, the capital sum is paid out in full for certain events, such as death or loss of both limbs, while lesser amounts may be paid for partial disabilities, such as the loss of a single limb or sight in one eye. The capital sum helps provide financial support after a serious accident or unexpected event, offering a clear and predefined payout to help cover expenses during a difficult time. Corridor deductible. A corridor deductible is a specific type of deductible that applies in some health insurance policies, especially in plans that combine major medical insurance with supplemental coverage, like critical illness or accident insurance. The corridor refers to a period or range between the basic coverage amount and the point at which the full benefits of the policy kick in. Here's how it works. In a plan with a corridor deductible, the insured will need to pay a certain amount of out-of-pocket expenses before the insurance starts to pay at a higher level. For example, let's say a policy has a $5,000 basic deductible, and there is a corridor deductible of $2,000. This means the policyholder must pay the first $5,000 of covered expenses under the basic plan, and after that, they will pay another $2,000, the corridor deductible, before the supplemental coverage or higher-level benefits start to cover further costs. The purpose of a corridor deductible is to create a buffer or transition between the lower basic coverage and the more comprehensive coverage, ensuring that the policyholder shares some of the costs before the plan provides the maximum benefit. It's common in certain types of health insurance, especially when supplementary or secondary coverage is involved. Contributory plan. A contributory plan is a type of insurance plan where both the employer and the employee share the cost of the premiums. In this setup, the employee contributes a portion of the premium payments, while the employer covers the remainder. This is common in employer-sponsored health insurance or life insurance policies where the employer provides a basic level of coverage, and the employee has the option to contribute toward the cost of more comprehensive coverage or additional benefits. For example, in a contributory health insurance plan, the employer might cover 70% of the premium costs, and the employee would be responsible for the remaining 30%. The employee's contribution could be deducted directly from their paycheck, making it easier for them to pay. Contributory plans differ from non-contributory plans, where the employer covers the entire cost of the premiums, and the employee doesn't have to make any payments. The contributory approach helps share the financial responsibility between both parties, often allowing employees to access insurance coverage that they might not be able to afford on their own. Business overhead expense insurance. Business overhead expense insurance is a type of insurance designed to help business owners cover the fixed operating costs of their business if they become disabled and are unable to work. This insurance helps ensure that the business can continue to pay for ongoing expenses, like rent, utilities, salaries, and other essential operational costs, during the period the owner is disabled. For example, if a small business owner who runs a bakery suffers an injury and can't work for several months, business overhead expense insurance would help cover the bakery's rent, employee salaries, and other bills. It ensures that the business doesn't fall behind on financial obligations, allowing it to stay afloat while the owner focuses on recovery. This type of insurance is often used by sole proprietors, partnerships, or small business owners who are the primary drivers of the business's day-to-day operations. It typically doesn't cover the business owner's income, but focuses solely on the costs required to keep the business running without interruption. Assignment of benefits. Assignment of benefits is a process in insurance where the policyholder transfers their right to receive benefits or payouts directly to a third party, such as a healthcare provider or repair shop, rather than receiving the payment themselves. This is commonly used in health insurance and other types of coverage where the policyholder needs services but prefers to have the insurance company pay the provider directly. For example, if you go to the doctor and have health insurance, you may sign an assignment of benefits form, allowing the insurance company to send payment directly to the doctor for the medical services you received. This saves you from paying out-of-pocket up front and waiting to be reimbursed, and ensures that the provider is paid directly by the insurer. In the context of health insurance, this process simplifies billing for both the insured person and the provider, but it also means the insured loses direct control over the benefits they would otherwise receive. It's important for policyholders to be aware of the terms and ensure they understand who will be receiving the benefits and under what circumstances. Blackout period. A blackout period refers to a specific period of time during which certain activities or actions are restricted or unavailable. In the context of insurance, a blackout period often refers to a waiting period during which a policyholder cannot access certain benefits or make changes to their policy. For example, in health insurance, a blackout period might occur after a policyholder has just enrolled in a new plan or after a major life event, like changing jobs. During this time, the insured might not be able to make changes to their coverage, such as adding dependents or switching plans. In the context of life insurance, a blackout period could occur when a beneficiary is temporarily unable to receive benefits due to administrative reasons or until the insurer processes the claim. In retirement planning, the term blackout period is also used to describe times when employees are not allowed to access or make changes to their 401k or other retirement plan accounts, typically during plan changes or transitions. During a blackout period, the participant might not be able to move investments or access funds until the restrictions are lifted. Overall, a blackout period acts as a temporary hold on specific actions, typically for operational, processing, or regulatory reasons. Blanket policy. A blanket health insurance policy is a plan that provides coverage for a group of individuals, such as employees of a company, under one single policy. Instead of each employee having a separate health insurance policy, the company or organization provides a collective policy that covers all eligible employees. These types of policies are often used in group health plans provided by employers. For example, an employer may offer a blanket health insurance policy that covers all full-time employees and their dependents. Instead of each person having their own individual policy, the entire group benefits from the same terms and coverage under one plan. This could include coverage for hospital visits, doctor's appointments, prescription drugs, and other health services. The policy may also extend coverage to employees, spouses, and children. A blanket policy can be more affordable for both the employer and employees, as group coverage typically offers lower premiums than individual policies. However, while this is efficient and cost-effective, it usually means employees don't have the same flexibility or range of choices they might have with an individual health insurance plan. Entire contract provision. The entire contract provision in health insurance refers to a clause in the insurance policy that states the policy, along with the application and any attached riders or endorsements, represents the complete and final agreement between the insurer and the policyholder. This means that the terms and conditions outlined in the policy documents are all that will govern the coverage, and no other agreements or representations outside of this written contract will be considered valid. For example, if you purchase a health insurance policy and the insurer makes verbal promises or offers additional coverage options outside of what is written in the policy, those verbal agreements will not be legally binding. Only what is outlined in the written contract, policy, application, and any attachments is considered the true agreement. This protects both the insurer and the policyholder by ensuring that all terms are clearly defined and that no misunderstandings or surprises arise due to off-the-record promises or modifications. This provision helps avoid confusion or disputes in the future, as it reinforces the idea that the written document is the final and complete source of coverage details and obligations. If changes are made or additional terms are agreed upon, they must be formally added to the policy in writing to be valid. Disability Buy-Sell Agreement. A disability buy-sell agreement is a legal contract used by business owners to ensure that, in the event of one owner becoming disabled and unable to work, their share of the business can be purchased by the remaining owners or the business itself. This type of agreement is designed to protect both the disabled owner and the remaining owners, ensuring that the business continues to operate smoothly without disruption, and that the disabled owner or their family receives fair compensation for their stake in the business. For example, let's say you and a business partner own a medical practice together. If one of you becomes disabled and unable to continue working, a disability buy-sell agreement would outline how the disabled owner's share of the practice is to be bought out. This could be done with the help of disability insurance that funds the buyout, allowing the business to remain operational while the disabled partner's family or estate receives a lump sum for the business's value. This type of agreement is particularly common in partnerships or small businesses, where the owners want to plan ahead for potential disabilities that might impact the business. It ensures that the business is not left in limbo, and the disabled owner is compensated for their ownership interest without causing financial strain on the remaining partners or the company itself. Experience rating. Experience rating is a method used in health insurance to determine premiums based on the claims history of a particular group or individual. Instead of setting premiums purely based on broader factors like age or location, experience rating adjusts the premiums based on how much the group or individual has cost the insurer in terms of claims over time. For example, if a company offers group health insurance to its employees, the insurer might use experience rating to adjust the premiums for the next year based on the previous year's claims. If the company had a high number of health claims, e.g., many employees required expensive medical treatments, the insurer might raise the premiums for the next year because the group has proven to be a higher risk. On the other hand, if the company had fewer claims, premiums might stay the same or even decrease. Experience rating is often used in employer-sponsored health insurance plans and is a way for insurers to price coverage based on the actual risk posed by the group. It's different from community rating, which sets premiums based on broader factors and doesn't take the individual claims history of a specific group into account. This method encourages companies to focus on improving health outcomes and managing healthcare costs to keep their premiums lower. Elimination period. The elimination period is the waiting period between when an individual becomes disabled or experiences a covered health issue and when their disability insurance benefits begin. It is essentially a deductible in terms of time, meaning the policyholder must wait a certain amount of time before the insurer starts paying out benefits. For example, if you have a disability insurance policy with a 30-day elimination period and you become disabled due to an illness or injury, you would need to wait 30 days before your benefits are activated. During this period, you would not receive payments from the insurance company, so the policyholder typically needs to rely on other savings or sources of income during that time. The length of the elimination period can vary based on the terms of the policy, and choosing a longer elimination period usually results in lower premiums. The elimination period is different from a waiting period for things like medical treatments, as it specifically refers to the time before disability benefits kick in. It's important to understand the elimination period when purchasing disability insurance, as it determines how long you may have to manage without financial support. Fully insured. In health insurance, fully insured refers to a situation where an individual or a group has complete coverage under an insurance plan, meaning all necessary premiums are paid, and the insurer is obligated to provide full benefits as outlined in the policy. This typically means that the insurance policy covers a wide range of healthcare services, and the policyholder is not required to pay for these services out of pocket, beyond the usual deductibles, co-pays, or co-insurance. For example, if an individual is fully insured under a health insurance policy, it means they have paid their premiums and are entitled to the full benefits described in their plan, such as coverage for doctor visits, hospital stays, prescription drugs, preventive care, and emergency services, depending on the specifics of the policy. In contrast, if someone is not fully insured, they might have a limited policy with gaps in coverage, meaning they would not receive full benefits in some situations. In the context of employer-sponsored health insurance, a fully insured plan typically means the employer has contracted with an insurance company to provide the entire health insurance package for employees, and the insurer assumes the financial risk for covering healthcare expenses. This is in contrast to a self-insured plan, where the employer takes on more of the financial responsibility for covering employee health costs. Independent agency system. The independent agency system in health insurance refers to a distribution model where independent agents or brokers sell health insurance policies on behalf of multiple insurance companies, rather than being tied to a single insurer. These agents are not employees of any one company and work independently to find the best coverage options for their clients, offering policies from different insurers to suit individual needs. For example, if you're looking for health insurance, an independent agent might present you with options from several different insurance companies, helping you compare plans, premiums, coverage, and other factors. This allows the agent to offer a broader range of choices, ensuring that you find a plan that fits your needs and budget. Unlike captive agents, who work exclusively for one insurance company, independent agents have the flexibility to offer a variety of plans from multiple insurers. This gives consumers more options and allows agents to act in the best interests of their clients, rather than being limited to the offerings of just one insurer. It's a system that promotes choice and flexibility, which can be especially helpful when navigating the complex world of health insurance. Indemnity Approach. The indemnity approach in health insurance refers to a type of insurance policy that reimburses the insured for expenses incurred due to illness or injury, up to a certain limit specified in the policy. The goal of the indemnity approach is to restore the policyholder to the financial position they were in before the loss occurred, based on actual expenses rather than paying out a fixed amount. For example, if you have a health insurance policy with an indemnity approach and you incur medical expenses from a surgery, the insurance would reimburse you for the costs, but only up to a specified maximum. If your surgery costs $10,000 and your policy covers 80% of the expenses, the insurance would pay you $8,000, leaving you responsible for the remaining $2,000, depending on your deductible or copays. This model contrasts with managed care plans like health maintenance organizations, HMOs, or preferred provider organizations, PPOs, which typically have more restrictions on where you can receive care or how much the insurer will cover. The indemnity approach provides more freedom of choice in healthcare providers, as it does not require policyholders to use a specific network of doctors or hospitals, but it often comes with higher out-of-pocket costs. Hospital indemnity. Hospital indemnity insurance is a type of supplemental health insurance that provides a fixed daily, weekly, or monthly benefit if you are hospitalized due to illness or injury. This insurance is designed to help cover the out-of-pocket costs that come with being in the hospital, such as deductibles, copays, or other non-medical expenses like lost wages or childcare. For example, if you're hospitalized for surgery and your policy provides a daily benefit of $100, the insurance would pay you $100 each day you're in the hospital, up to a specified number of days. This can be especially helpful if you have a high-deductible health plan or if you're concerned about the financial strain of missing work while you're recovering. Hospital indemnity insurance doesn't cover the actual medical expenses like regular health insurance does, such as doctor visits or surgeries. Instead, it provides a cash benefit that you can use as you see fit. It can help with the indirect costs of hospitalization, such as paying for transportation, childcare, or even covering bills that pile up while you're out of work. This type of insurance is typically offered as a supplement to existing health insurance policies, filling in the gaps where other insurance might not provide enough financial support during a hospital stay. Key person insurance. Key person insurance is a type of life or disability insurance taken out by a business to protect itself in case a key employee, someone critical to the operation and success of the business, becomes seriously ill, disabled, or dies. The business itself is the beneficiary of the policy, and it receives the payout to help cover the financial losses or expenses that may arise from losing that key person. For example, in a small business where the owner is the driving force behind the company's sales, operations, or management. The business might take out a key person insurance policy on the owner. If the owner becomes disabled or passes away, the policy would provide the business with a lump sum payment that could help cover the costs of hiring a replacement, keeping the business running, or managing the financial disruption during the transition period. The insurance helps the business absorb the financial impact of losing a crucial employee, ensuring that the company can continue operations without immediate financial strain. It's especially common in businesses where the expertise, skills, or leadership of one or a few people are vital to the company's success, such as in law firms, consulting businesses, or tech startups. Impairment rider. An impairment rider is an addition to a health insurance policy that excludes coverage for a specific pre-existing condition or injury. This rider essentially removes the insurer's obligation to cover any medical expenses related to that particular condition, either temporarily or permanently. It's often used when an individual applies for a policy and has a health condition that is deemed too risky or expensive to cover under the normal terms of the policy. For example, if someone has a history of back problems and applies for health insurance, the insurer may include an impairment rider that specifically excludes coverage for back-related issues. This means that if the individual needs treatment for their back in the future, the insurance policy won't cover it, but it would cover other conditions that are not related to the back. Impairment riders are typically used to allow people with existing health conditions to still obtain coverage, but with some exclusions. While the rider helps the insurer reduce risk, it also allows the insured to get a policy, even though they may have a medical history that would otherwise disqualify them for full coverage. It's important for the policyholder to understand the details of any impairment rider to know exactly what conditions are excluded from coverage. Limited policies. Limited policies in health insurance are policies that provide coverage for specific, limited benefits or types of care, rather than offering comprehensive coverage. These policies are typically more affordable than full health insurance plans, but they come with restrictions on what is covered. Limited policies might focus on a particular type of care, such as accident coverage, hospital stays, or critical illness insurance, and exclude other healthcare needs like routine doctor visits, preventive care, or prescription medications. For example, a limited hospital indemnity policy might only pay for hospital-related expenses if you are admitted for a covered illness or injury. However, it wouldn't cover outpatient care, doctor's visits, or medications. Similarly, a critical illness policy might only pay a lump sum if you're diagnosed with a specific condition, such as cancer or heart disease, but it wouldn't cover other health needs. While limited policies can be a good option for people who need help with a specific risk or expense, they are not a substitute for comprehensive health insurance. They can help fill gaps in coverage, but often leave significant healthcare needs uncovered, which is important to keep in mind when considering this type of insurance. Medicare Part B. Medicare Part B is a part of the federal Medicare program that helps cover certain medical services and supplies that are necessary for the diagnosis or treatment of a medical condition. Unlike Medicare Part A, which covers hospital stays, Part B focuses on outpatient care and services. This includes things like doctor's visits, preventive services, such as screenings and vaccines, certain types of medical equipment, like wheelchairs or oxygen, and some lab tests. For example, if you see a specialist for a condition like diabetes or need routine blood work, Medicare Part B would typically cover the costs subject to certain conditions like deductibles or copays. It also covers certain outpatient surgeries and some home health care services that are not covered under Part A. Medicare Part B generally comes with a monthly premium that beneficiaries must pay, in addition to other costs like deductibles and coinsurance. The program is optional, but most people who are eligible for Medicare Part A also sign up for Part B, because it covers a broader range of healthcare services. However, it's important to review the coverage and costs to decide if it's the right choice for you, as some individuals may choose to delay enrollment if they have other coverage options. Lloyd's of London. Lloyd's of London is not an insurance company, but rather an insurance marketplace where various underwriters, brokers, and insurers come together to offer specialized insurance coverage. It operates as a market rather than a single entity, and it's known for providing coverage for unique, high-risk, or unusual insurance needs that may not be covered by standard insurance companies. The marketplace is made up of syndicates, which are groups of underwriters who pool their resources to take on insurance risks. For example, if you were looking to insure a rare item like a famous piece of art or a celebrity's body part, you might turn to Lloyd's of London, as it has a reputation for covering unusual and niche risks. Similarly, it has provided coverage for complex commercial risks, like oil rigs or large-scale international shipping. Lloyd's is based in London but has a global presence, and it's known for its ability to handle complex and high-value insurance policies. It's also a place where brokers can bring clients with specific or difficult-to-place insurance needs, making it a central hub for specialized coverage in the global insurance industry. While Lloyd's itself doesn't provide the insurance, it plays a key role in facilitating these arrangements and offering solutions through its network of underwriters. Medicare Supplement Policy. A Medicare Supplement Policy, also known as Medigap, is a private insurance policy that is designed to fill the gaps in coverage left by Original Medicare, Part A and Part B. While Medicare covers a wide range of healthcare services, it doesn't pay for everything, and there are deductibles, co-pays, and co-insurance that beneficiaries must pay out of pocket. Medigap policies help cover these additional costs, reducing the financial burden on individuals. For example, if you have Medicare and go to the hospital, Medicare Part A will cover your inpatient care, but you might still have to pay a deductible and a portion of the costs for each day you're in the hospital. A Medicare supplement policy could cover those out-of-pocket expenses, so you're not responsible for paying those amounts yourself. Medigap policies are sold by private insurance companies and are standardized into different plans labeled A through N, with each plan offering a different set of benefits. The key difference between the plans is the range of coverage they provide for things like hospital coinsurance, skilled nursing facility care, and foreign travel emergencies. It's important to note that Medigap policies only work with Original Medicare, Part A and Part B, and they don't cover things like prescription drugs, which are covered under Medicare Part D, dental, or vision care. Overall, a Medicare supplement policy can provide extra peace of mind and reduce out-of-pocket costs for those who are enrolled in Original Medicare. Major Medical Expense Policy. A major medical expense policy is a type of health insurance that provides broad coverage for a wide range of healthcare services, including hospital stays, surgeries, outpatient care, and medical treatments. These policies are designed to help cover high medical costs, particularly those that could lead to significant financial strain, like extended hospitalizations or expensive surgeries. The goal of a major medical policy is to protect individuals from catastrophic healthcare expenses by offering comprehensive coverage. For example, if you were to have a serious accident or develop a major illness like cancer, a major medical expense policy would typically cover the costs of your hospital stays, surgeries, treatments, and even some follow-up care, depending on the policy details. However, these policies generally come with deductibles, co-pays, and co-insurance, which means you would still be responsible for part of the costs. Major medical policies typically have a higher coverage limit than more basic health plans, and they usually cover a wider range of services. They often provide coverage for things like inpatient and outpatient care, emergency care, surgeries, doctor visits, and sometimes even preventive services. This type of policy can be an important safety net, especially for those who want more comprehensive coverage beyond basic or limited health insurance plans. Misstatement of age or sex provision. The misstatement of age or sex provision in a health insurance policy is a clause that addresses the situation where the policyholder accidentally provides incorrect information about their age or gender when applying for coverage. Since the premiums for many health insurance policies are partially based on age and sometimes sex, this provision ensures that if a mistake is made, the insurance company can adjust the benefits or premiums accordingly. For example, if a person mistakenly states they are 10 years younger than their actual age when applying for insurance, and the insurer later discovers the error, the policy may be adjusted to reflect the correct age. This could involve increasing the premium to match what it would have been had the insurer known the correct age. In some cases, if the error results in the policyholder being underinsured, the insurer may adjust the benefits as well, potentially reducing the payout for any claims. This provision is designed to prevent fraud or misrepresentation by ensuring that the insurer has accurate information to determine appropriate coverage and premiums. It's also important to note that the insurer typically doesn't cancel the policy outright due to a simple mistake, but they may adjust the policy's terms based on the corrected information. Managed Care Organization. A managed care organization, MCO, is a health insurance plan or company that coordinates the delivery of healthcare services to its members, aiming to improve the quality of care while controlling costs. MCOs work with a network of healthcare providers, like doctors, hospitals, and specialists, to offer services at reduced rates. The idea is to manage both the cost and the quality of care by directing how and where members receive treatment. For example, in a health maintenance organization, HMO, which is a type of MCO, members are required to choose a primary care physician, PCP. This doctor acts as a gatekeeper, meaning you need to visit them first for most health issues. If you need to see a specialist or get more specific care, your PCP typically needs to provide a referral. This system helps the insurer control costs by ensuring that treatments are necessary and efficient. Other types of MCOs include Preferred Provider Organizations, PPOs, and Point of Service, POS plans, which offer varying levels of flexibility regarding which doctors and specialists you can see. MCOs focus on preventive care, cost-effective treatment options, and better health outcomes. They often offer programs that encourage members to manage chronic conditions, get routine screenings, and follow wellness protocols, all of which help reduce overall healthcare costs while improving member health. However, some individuals may find the restrictions, like needing referrals or being limited to certain providers, less flexible compared to traditional fee-for-service insurance. Morbidity. Morbidity refers to the incidence or prevalence of disease, illness, or injury within a specific population. In health insurance, it's often used to assess the risk of individuals developing certain conditions, which helps insurers determine premiums and coverage options. Morbidity can be used to describe both the number of cases of a particular disease and the severity of illness in a population. For example, if a health insurance company is evaluating a group to set premiums, they may consider the morbidity rate of certain conditions like heart disease or diabetes in that group. A higher morbidity rate, meaning more people in the group are dealing with those health issues, may lead to higher premiums because the insurer anticipates higher healthcare costs. In the context of an individual, morbidity refers to the likelihood of experiencing illness or a health condition during their lifetime. Insurance companies consider morbidity as part of their underwriting process when determining whether to issue a policy and how much to charge. By understanding morbidity, they can predict future claims and make decisions to ensure they can cover those potential costs. Multiple Employer Trust, MET. A multiple employer trust, AMET, is a group insurance plan where several small businesses or employers come together to pool their resources and provide health insurance or other benefits to their employees. By participating in a MET, these employers can take advantage of the larger group to negotiate better rates, lower premiums, and broader coverage, which might not be available to them individually due to the size of their workforce. For example, imagine a small business with only 10 employees. On its own, this company might face high premiums or limited health insurance options. However, by joining a MET, the business can combine its employees with those of other small businesses in the trust, increasing the collective bargaining power and potentially reducing the overall cost of insurance. This way, the MET offers a more affordable way for small employers to provide health coverage, similar to the benefits larger companies might enjoy. The employers within a MET are not directly responsible for each other's claims, but they share the risk and benefits of the plan. These types of arrangements are commonly used in industries where businesses are related or work in similar fields, like retail or construction. However, METs must comply with specific regulations to ensure they are structured properly and meet the requirements set forth by government agencies, like the Department of Labor, to maintain their tax advantages and legal status. Medical Information Bureau, MIB. The Medical Information Bureau, MIB, is an organization that collects and shares medical information about individuals to help insurance companies assess risk when applying for life, health, and disability insurance. MIB gathers data from insurers, which may include an applicant's medical history, such as past diagnoses, treatments, or claims. This information helps insurance companies make more informed decisions about underwriting, ensuring they have accurate and comprehensive details when evaluating an applicant's risk. For example, if you're applying for health insurance and have a history of a medical condition like diabetes, the insurer may request information from the MIB to verify your health history. If you've previously applied for life insurance and disclosed certain conditions, that information may be available through MIB, helping the new insurer assess your application more accurately. The MIB acts as a resource for insurers to flag potential misstatements or omissions in an application. If an individual leaves out important details, such as a pre-existing condition, the insurer may discover this by checking the MIB database, which could lead to adjustments in the policy terms or even denial of coverage. The MIB maintains a strict privacy policy, and individuals can request a copy of the information held about them. Additionally, if there are errors in the report, individuals can work with the MIB to correct or update their medical information. Non-cancelable renewal provision. A non-cancelable renewal provision is a feature in some health insurance policies that guarantees the policyholder's coverage will not be canceled or changed by the insurer, as long as the premiums are paid on time. This provision ensures that the insurance company cannot increase premiums or alter the terms of the policy, such as limiting coverage, during the renewal period. For example, if you have a health insurance policy with a non-cancelable renewal provision, the insurer cannot cancel your policy or raise your premiums based on changes in your health or age, provided you continue paying your premiums as agreed. This gives policyholders more stability and peace of mind, because they know their coverage will remain intact even if they develop health issues that might otherwise make it difficult to get new insurance or result in higher premiums. This provision is most commonly found in disability or health insurance policies and is especially beneficial for individuals with ongoing health concerns or for those seeking long-term coverage without the risk of sudden changes in terms or cost. It provides a layer of security as it essentially locks in the policy's terms for a set period, often until a certain age or for the duration of the policyholder's lifetime. Non-scheduled plan. A non-scheduled plan is a type of health insurance plan where the insurer reimburses the policyholder for a wide range of medical services based on actual costs incurred, without setting specific limits or schedules for each type of treatment or service. This means that, unlike scheduled plans, which have predefined coverage amounts for specific services, such as $100 for a doctor's visit or $500 for a surgery, non-scheduled plans provide reimbursement based on the actual charges up to a certain limit, or maximum, rather than following a set schedule of benefits. For example, with a non-scheduled dental plan, if you go to the dentist for a filling, the insurer would reimburse you for the actual cost of the procedure up to a certain maximum amount rather than providing a fixed reimbursement amount based on a set schedule. This gives you more flexibility to choose healthcare providers and services, but it also means that you might be responsible for paying the difference if your medical bills exceed the reimbursement amount provided by the insurance. Non-scheduled plans are typically seen in health insurance policies, particularly for dental and vision coverage, and they can provide more comprehensive protection compared to scheduled plans. But they may also involve higher premiums or out-of-pocket costs for policyholders. Principal sum. The principal sum refers to the amount of money specified in an insurance policy that represents the maximum benefit the policyholder or their beneficiaries will receive in the event of a covered loss. In terms of health insurance, this is often related to accidental death and dismemberment, AD&D policies, or similar coverage. For example, in an accidental death and dismemberment policy, the principal sum might be set at $100,000. If the policyholder dies in an accident, their beneficiaries would receive the full $100,000. If the policyholder loses a limb or their sight in an accident, they might receive a portion of that $100,000, typically depending on the severity of the injury. A loss of a limb might result in a payout of 50% of the principal sum, or $50,000, while the loss of sight could result in a different payout. The principal sum is a key component of many types of life and accident-related insurance policies, serving as a predetermined amount that determines the benefits provided to the insured or their family.